Very good morning, friends. I hope everybody is doing good. Our journey in terms of consolidation, I think now starts, though we've been doing consolidation, but that was Business Combination Standard Indes 103. Now, if you recall, when we laid down the introduction to Indes 103, I'd given you a plethora of standards dealing with the concept of consolidations under various permutations and combination. So today we begin with Ind AS 110, that is consolidated financial statements. And that gets triggered when you establish a control between investor as well as the investee. Now, I would say there are a total of three main focus points in terms of this standard. So as we're going to make revisions on this standard along with doing questions as well, so we're going to make a thrust in terms of three areas of thing. I would say the first area, of course, is going to be combined with the first part. So the first focus is to understand, are there any kind of exemptions which are available under the standard where the company is got a choice of not consolidating or it is mandated not to consolidate. Mind the words, I said very clearly. I said, what are the situations where a company is given a choice of not consolidating and where the company is mandated not to consolidate? Then along with this, of course, I can say we also need to see the aspect of control assessment. Let's put it as a second area then. So control assessment, we know as per this Ind AS, is not supposed to be a rule-based assessment, but it is supposed to be, you can say, a principle-based assessment. Because as we know, in terms of 110, there is no percentage which is given, which defines that, yes, if you get more than 50% voting power in a company, you get a control. But there is an assessment which is required on the basis of certain parameters. So that is a second area of focus. The third is, of course, dealing with the consolidation. How would a company make a consolidated financial statements that is both a balance sheet as well as an income statement? And that is the core practical area, I would say, in the standard. And the fourth is about, you can say, changes in ownership interest. When an investor makes a further investment or when an investment disposes of a certain stake of investment, it could lead to either a loss of control or it will lead to the control being continued. There could be a lot of permutation combinations which could happen on that particular front as well. So broadly, I would say that Indes 110 from an examination point of view could be divided, I would say, largely in four sections. Understanding the scope of the standard, in which particular cases are we told that you get a choice or we are told you cannot consolidate. The second is the area understanding the control assessment. The third is the area of doing the practical consolidation. Of course, we'll have a lot of stress on that area. How does a consolidated balance sheet income statement gets made? And number four, the changes in the ownership interest. So once you're done with these four areas, you are almost done, almost, I would say, examination point of view, done with Indes 110. So thereafter comes the other consolidation standards like Indes 111, Indes 28, which would follow after this particular standard. So let's begin the journey. So we're going to spend almost like, you can say, 3 sessions on 110, followed by 1 session on 111, and followed by another 1 session on Indes 28. So we've got 5 sessions in totality in terms of consolidated financial statements, 110, 111, as well as 28. So let's begin the journey with the very first section on Ind AS 110. So I think that would also act as a warm-up exercise, starting with a very simple little input on scope. So this is CFS, and that's called Consolidated Financial Statements. Now, when it comes to the scope of the standard, I'll just quickly give you some inputs, then I think we can do some questions on that area. So I would divide the scope of the standard in terms of 2 broad situations. I'll divide the scope of the standard in terms of 2 broad situations. So I would say there is a situation number 1. I guess if I want to technically put it, it is covered by para number 4, clause A. And there is a situation number 2, which is covered by the para number 4B. That's capital B, and is further elaborated by other paras as well. Now, what is the difference between the two? I think let me first, give you a quick recap in terms of the differences between the two. Number one, if you look at the first case, that is situation one, it is basically talking of a situation where you get a choice of consolidation. The company basically gets an option and it may decide to consolidate or not to consolidate. And if you look at the situation number two, it is a situation which is mandatory. If the conditions are met, consolidation cannot take place. So I think this is one area which one needs to be very careful. That there are two areas given in the standard. The par number is not important, but what is important is to understand that there are two situations given in the standard. One talks about that, we get a choice of consolidation. You want to, you can, you don't want to, you may not. That's optional in nature. The other situation is mandatory, where the standard tells you clearly that you cannot consolidate. Now, another thing which you need to keep in mind is the first situation, which is talked in terms of para 4A, gets triggered. It gets triggered only in a situation where there is a chain holding. I don't think so. I need to really tell you that what is a chain holding. The chain is A in B, B in C. So there is a particular chain. But when it comes to the situation number two, this applicability could trigger even if there is no chain holding. So I would not say that there may not be chain holding, but I can say there may or may not be chain holding. So there may or may not be a chain holding. It would trigger in both circumstances with as well as without the concept of chain holding. So I think I'm just going to take a quick recap on the two situations, but I think this is the broader view, which should be very clear in your mind that what is the situation one. It is an option, but applies only in case of chain holding. And the second one is mandatory as applicable, whether it is a case of chain holding or not. Okay, so let's, I think, take a recap on situation one. So when I look at the situation number one, which I said is completely optional in nature, so we need to just keep in the background a situation where there is a chain holding. So let's consider A is got a control in B and B is got a control in terms of C. That's what is chain holding. Now, the para number 4 clause A gives you a total of 4 conditions, and each of these conditions need to be met. If you fail even one of the conditions, then the option is not available. So in this particular case, let's remind what are the 4 conditions given in the standard. And in order to get the choice, you need to meet all the 4 conditions. Even if one of the condition fails, then the choice is not available. So let's recall what are the 4 conditions which are there. The condition number 1 is that the parent is got 100%. And let me also, I think, pinpoint one thing, that in terms of the para number 4A, your focus has to be on the middle company. Your focus has to be on the middle company, because when you're looking at the 4 conditions, these 4 conditions is got to be met only, you can say, by the middle company. So there are 4 set of conditions. The condition 1 is, in my example, A is got a 100% stake in B. So B basically is a wholly owned subsidiary of A. That's 1. Or you can prove that A is got, let's say, less than 100%. So B is a partly owned subsidiary. And when B becomes a partly owned subsidiary, you need, I would say, an NOC, a no objection from the other stakeholders. So let's say A has got an 80% stake in B. Then you need those 20% stakeholders should have no objection if B does not consolidate. Second, B is not a listed company. Third, B is not in the process of getting listed. And number 4, the ultimate parent or any intermediate parent. In our example, A becomes the ultimate parent. If the chain is longer, let's say there is somebody above A as well, then I would say the ultimate parent is, let's say, X on the top of A. So the ultimate parent or the intermediate parent is presenting consolidated financials, one, and that is to be presented as per Ind AS, there is two. So in this particular case, let's, I think, lay down the four conditions. So we've got condition number one, that we can say B is a wholly owned subsidiary. B is a wholly owned subsidiary of A. So B is a wholly owned subsidiary of A, that is one, or alternatively, you need to prove that B is partly owned. So we can say B is partly owned. So B is a partly owned subsidiary of A. B is a partly owned subsidiary of A plus NOC. I'm putting it as NOC, no objection. It's not a no objection certificate. So please don't make a mention in the exam that you need a NOC, because the standard does not say that you need a no objection certificate. I mean, this is just to make your life simple, that you remember there is something called NOC out there. So this is getting an NOC from, you can say, other shareholders. So we are able to get a no objection from the other shareholders that they've got no problem if B does not make a consolidated financials. Second condition is that B is not listed. The second condition is that B is not listed. The third condition is B is not in the process of getting listed. B is not in the process of getting listed. So neither it's a listed company nor it is a potentially listed company. That means not in the process of getting listed as well. And finally, number four, as we said, that the ultimate parent, so we can say the ultimate or any intermediary parent. So ultimate or any intermediate parent. So ultimate or intermediate parent, we can say there are two conditions: presents consolidated financial statements, and we can say as per Ind AS 110. So they need to present it as per the Indian accounting standards. Okay, so I think that takes care of the situation number one. We've got the broad outlook that when you're looking at a concept of a chain holding, in this particular case, the middle company gets the choice. The middle company gets a choice of consolidating or not. So you need to put across a total of four questions. B is not a listed company. B is not in the process of getting listed. A either has got a 100% stake in B, or A has got a certain percentage in B, and the other shareholders have got no objection if B does not present a console. And either A or any company above A, so any ultimate or intermediate parent, is presenting consolidated financials, one, and those should be as per Ind AS. Okay, so that I think takes care of one thing. And I guess I don't want to remind you another small little input. I think let that be as a part of the practice as well. There is something, which I've not reminded you in this particular notes, but I think that should be taken as a surprise element in terms of doing questions. So this is situation number one. I hope you're very clear with the situation number one. Let's now talk in terms of situation number two. So situation number two, to remind you, is a case where there may or may not be a chain holding, and that typically relates to the fact of an investment entity, where the parent, or you can say the investor, is an investment entity, where we go to apply a simple three-step model in terms of identifying whether any exemptions are available or not. So let's go to the situation number two. So in terms of the situation number two, there may or may not be a chain holding, but I guess let's consider a case of a chain holding to get a comprehensive view. Because in this particular case, when there is a chain holding, then I think there are some more inputs to be seen as well. So let's again consider the concept of a chain. So there is company A, there is company B, and there is C. But I'm just again reminding you that for situation number two, The concept of chain holding is not necessary. It gets triggered even if there is no chain holding. And also remember, it is something which is mandatory. If the conditions are met, then consolidation cannot take place. The standard mandates you that you cannot consolidate. Now, let's apply a simple three-step model in this particular case to make life simple. So first of all, in terms of the step number one, what you need to ask is, you need to first of all consider that is A, which is on the top, is that an investment entity or not? Because as we said that this is a specific situation which gets triggered only when the parent is an investment entity. So if you say that the parent is not an investment entity, then this situation cannot apply. So your first focus would be to identify, is A Limited, in my example, an investment entity? So you know the parameters of what is an investment entity. Basically a company which is created for the purpose of making multiple investments in unrelated parties with the objective of earning an interest and a capital appreciation. So something like an investment property, something similar on that concept, that you've created a company which is basically, taking money from a lot of unrelated investors and putting that money, investing that money with the sole objective of getting a capital appreciation, or you can say an interest income or a dividend income return, which you need to say. So when your focus is that A Limited is an investment entity or not, so you would get the answer either a yes, or you get the answer that either it is a no. So in any case, if the answer comes a no, then this particular, you can say, mandatory exception would not apply. So then I would say the three-step model is not applicable. In other words, you can say A is required to do the consolidation. So I think it's better to put it like this, that we can say in this particular case, we can say A Limited is required. A Limited is required to prepare and present the consolidated financial statements. He would get no mandatory exceptions in this particular case. But if you say a yes, then in this particular case, since we're focusing on the chain, we go to the step number two. And then in terms of the step number two, your focus is now going to be on the middle company. So first you look at the parent company, which is on the top of the chain, that is it an investment entity or not? If yes, you go to the chain and see the middle company is an investment entity or not. So we look at, is B Limited an investment company? So we'll see that is B Limited an investment entity? So here again, when you put across the question that is B Limited an investment entity, again, the answer would be a yes, or the answer would be a no in this particular case. So when you go look at the situation that you say that yes, it is supposed to be an investment entity, so the answer is either a yes or a no. So if you say a yes, then in this particular case, he gets an exemption. He gets an exemption in this particular case. So when we say that is E supposed to be, so we can say he gets the exemption. He is not required. Gets the exemption means he is not required. And this is mandatory. He cannot prepare a consolidated financial statements in this case. But if you say a no, then it's time to go to the step number three. Okay, so I think this takes you to the two steps. Then there is a third step also, which we need to consider as well. So in this particular case, now in the third step, you're going to focus on what is the work which B Limited does. Is he doing a work which is similar to A Limited, or is he doing something which is not similar to A Limited? So my third focus point is going to be, my step number three would be, are the activities of B Limited related to A Limited? So are the activities of B Limited related to A Limited? Is he carrying on the same work or not? So in this particular case, if you say yes, it is similar, he's carrying on a similar activities, then consolidation would be required. Consolidated financial statements are presented because then you can say that it's, consolidating apples with apples. That's what I always tell people. That if the work of B is related to similar to the work of A, then both are doing the same work and therefore consolidating apples with apples. But if the work of B is not related to the work of A, then it's maybe consolidating apples with orange and therefore the exemption is available. So in this particular case, when you say no, it's different. The work which B Limited does is different as compared to the work which A Limited does. In that particular case, you can say the exemption is available. The exemption is available in this case. So that makes it a three-step model in terms of the situation number 2. I think let's now connect the dots. Let me now just connect the dots back again out here. So your first focus point, and I think let me ask you a question also based on that. Let me first, I think, correct the dots, and then I'll just ask you a small little question as well. Then we can do some questions on this area. So presenting consolidated financial statements is a mandatory exercise. But then the standard has given us a total of 2 situations. One where the company gets a choice that if it fulfills the 4 conditions, it may decide not to present consolidated financials. The other situation is where the standard tells you on a mandatory basis that if these conditions are met, you cannot consolidate. That's not a matter of choice. The area where you don't get a choice is a case where the parent is an investment entity. So when you look at the situation number 1, where you get a choice, there are a total of 4 conditions. And the focus is that there is a chain holding. And if the conditions are met, you get a choice. So that's a very simple case that you need to look at the 4 conditions which I gave you, that if all these 4 conditions are met, then you get the choice. And if one condition fails, you do not get a choice. So I think the situation 1 is simple, that there are 3 focus points in your mind. Number 1, it is option. Number 2, applies when there is a chain holding. And number 3, there are 4 conditions to be met. Even if one condition fails, you get no choice. Then we come to the situation number 2. And situation number 2, we can say, then again, there are 3 focus points. One is that it is mandatory. The second is it can apply irrespective there is a chain or no chain holding. And the third is you follow a 3-step model, typically if it is a case of a chain holding. So in this particular case, if you say that there is a chain holding, you need to apply a 3-step model. But remember, this 3-step model is to be applied when there is a chain. If there is no chain, then you can simply say that, if there is only a case of A and B, you just need to see that A is an investment entity. That's it. But this 3-step model would trigger only in a situation when you see that there is a chain holding. Then you need to go, first of all, asking, is this an investment entity? You say a yes. Then you're looking at B, is this also an investment entity? So the focus on the 3-step model is on the B company. The focus is on the B company. Is he going to get the mandatory exceptions or not? So first, for the purpose of looking at the exceptions to B, you start looking at, is A an investment entity? I say yes. Is B an investment entity? I say yes. And then I say, okay, is the work of B related to A? If yes. So when you say, let's go back. So A is an investment entity, you say a yes. Then you say B is an investment entity, you say a yes. Exemptions are available. So in the only case we need to see is that A is investment and B is not investment. A is investment and B is not investment. You need to see what work B does. If B is doing a similar work related to A, apples with apples, consolidation will take place. If the work is different, doesn't make sense to consolidate. So that is the situations to be seen. So reminding you back on situation 2, this 3-step model is going to be applicable only when you are looking at things from company's B point of view. So this is applicable when you're looking at a chain holding and the focus is supposed to be a middle company. So here goes a simple question now. Can the benefit of situation 1 and 2 be available to a middle company, considering that situation 1 applies to chain, considering situation 2 can also apply to a chain? So can, in a given situation, both para number 4 clause A and the para number 4B become applicable to the middle company? Yes or no?
Sir, on the option A, it is not applicable because there is no chain holding.
No, I'm looking at, a chain holding only. So in a chain holding only, can I say the middle company could get the benefit of 4A, clause A, and the benefit of 4B, both?
Yes, sir, it can get.
Correct. Absolutely. So, but in any case, let me tell you that if it is covered under 4A and 4B both, in those particular cases, 4B will override the clause 4A because A is optional and B is mandatory. So, if the middle company meets the parameters of 4B, then we will tell him that you cannot consolidate. The choice is gone. So, I think let's put that part as well. So, since we are discussing the concept of chain holding, so we can say in this particular case, the middle company, we can say the middle company, it might trigger the benefit of para number 4A as well. And it might also get the benefit of para number 4B as well. So both paras will become applicable to this particular company. And we can say the para number 4B overrides. The para number 4B overrides, you can say, the para number 4A. So the company is able to meet the parameters of both 4A as well as 4B. 4B is going to override. So we're going to tell him that you cannot consolidate in this case. I think we've done a quick revisions on the concept. Now it's time to apply these concepts to case studies. So now it's your turn. I've been doing a lot of talking for the last half an hour or so. I think it's now your turn
Sir,
to
last
look at
line,
this.
sir.
Yes. Yes.
You said that para 4B will override para 4A,
Correct.
and then you said that in this case you cannot consolidate.
Correct.
So, so I mean, so we'll not look at the conditions.
No, in the sense, like for example, in the chain holding, you've got company A, which has got in B, and B has got in C. You applied the 4 conditions of para number 4A. So that gives a choice to B, right?
Yes.
Now, you also applied the concept of the 3-step model in this case, and B is told that you cannot consolidate. Now, the question is that because of para 4A, B is getting a choice. And because of para 4B, we're telling you can't consolidate. So what
Okay.
is he going to listen, 4A
Yes.
or 4B?
So after application of steps in second part
Yes.
also.
So that's right. So that means once I'm evaluating both of them, then I'll tell the company B that you cannot consolidate. You cannot say that I've got a choice. I want to consolidate. I'll say, no, you can't. You got my point?
Correct, sir.
Yeah. Right. So this is, it's like, the middle company in the chain will all sometimes get a benefit. And this benefit comes only when B is an investment entity. So in a chain holding, remember, you'll have to look into the para number 4A also and para number 4B also, because if there is a contradiction that para 4A is saying you get a choice and para 4B says, no, you can't consolidate, we'll have to listen to para 4B because it mandates not to consolidate. Okay, so are you ready, I guess, to do some questions with you? So let me, I think, now share some questions to you. This is with reference to the scope of the standard. So let's have a look at this question. I hope it is visible. Can you see it clearly?
Yes, sir.
Wonderful. So let's, I think, read the inputs to you. So we are given company X has got 100% stake in company A, and company A has got 2 companies, B and C, with 100% stake. Can I call this as a chain holding?
Yes,
Yes,
sir.
sir.
Undoubtedly, yes. So in this particular case, once we look at this particular concept, let's now read the inputs out here. It says, following is the structure of a group headed by company X. It says company X is a listed entity in India, and prepares a consolidated financial statements as per the requirements of Ind AS. What is he trying to hint you? When it says
It,
it is a listed company preparing a consolidated financials as per Ind AS, what is the
which
hint?
means which means in the chain holding, the ultimate parent company is preparing the balance sheet,
Very
CFS.
good. So the fourth condition of the situation one is met. The ultimate parent is presenting console number one and as per Ind AS number two. Very good.
Satisfied.
Yes, then he says company A is an unlisted entity and is not in the process of listing. So what does this indicate?
Which means the second condition also is satisfied because it's not the unlisted company, it's not in the process also in the listing company. So second
Wonderful. So
condition
can
also
I say the
satisfied.
two more conditions are met? That the middle company is not listed, the middle company is not in the process of listing. So can I say three conditions effectively met out of the situation one? The middle company is not listed, the middle company is not in the process of listing, and the ultimate parent is presenting console as per Ind AS. So only one condition is left, and that is in this case, company X has got 100% stake in A. So can I say I can see that? So is the option under para number 4A available?
Yes, sir.
Yeah, yes, sir.
That's
4A is
fantastic.
available.
Correct. Then he says company X does not object to company A not preparing a consolidated financial. So I think in this particular case, even that condition is met. Though to my mind, since X has got 100% stake in A, we don't need an NOC because there is no NCI in terms of company A. So we don't need, because if you ask company X on the top, he is already a 100% owner. So he will say, yes, I have no objection, of course. So whether company A is required to prepare a consolidated financial statements as per the requirement of Ind AS 110, so we can say he is getting a choice. If he
Choice.
wants to consolidate, he can. Let me put it clear. If he wants to consolidate, he can. But if he doesn't want to consolidate, it's a choice.
Yes,
Next.
sir. This
Wonderful.
para 4 is given only the exemption, not
Yes,
exception.
absolutely clear. Then let's go to the scenario number B. Same situation, but we're changing the case. Assume the facts as per scenario A, except that X is a foreign entity. The company X is a foreign company and is listed in the stock exchange of a foreign country and prepares the financial statements as per the generally accepted principles applicable to that country. Can I outrightly say that the fourth condition gets failed? The
Yes,
ultimate
sir.
parent is not presenting console as per Ind AS, but
Yes,
as per
sir.
foreign companies gap. Correct.
Yes, sir.
Absolutely. So in this particular case, can I say in this case, A has to prepare consolidated financials?
Yes, sir. It is mandatory now.
Absolutely. So this is there because he cannot avail the conditions of 4A. Now let's look at the scenario number C. Same facts as in A, except that 100% of the investment in A is held by an individual, that is Mr. X. So, what do you say? Are the four conditions met?
No, sir. The first condition is not met because it's a partially held by the entity, not by the individual. It's clearly mentioned on the condition.
Very good. So, that was one missing link which I said, I'm not revising in the content, but let's check you later. So, that is the condition. That in condition number one, when you say that the middle company is a wholly owned subsidiary of the top company. So, what is important is that it is held by an entity and not by an individual. So, in the first condition, we need to see that somebody who has got shares in the middle company, somebody who's got a control over the middle company, cannot be an individual. So, since the first condition fails, then we can say the same conclusion comes applicable that A has to make consolidation. Okay, that's brilliant indeed. So a similar question absolutely was there in the RTP May 2020. So I'm not doing that question. So it is similar to what is given out here. So I think this is one question which is based on the situation number one. There is no reference in this question regarding an investment entity, and therefore the parameters of 4B are not applicable. Let's go further. So let's have a look at another two questions. Let me, I think, first crop this out. Right. I hope this is visible. Or otherwise, I can just cut off the top. Is that visible? Or you want me to zoom it a little further?
Little more, sir.
Okay, a little more. Okay, we'll just, I think, cut the upper part. Should go, I guess. Okay, now let's have a look at the structure which is given out here. Company A is got 100% stake in B, and A has got a 60% stake in C and 100% in X. Is this part a chain holding? A in C in X?
Yes. Yes.
Absolutely. So let's see what is the inputs. It says company A is a listed entity in India and prepares a consolidated financial statements as per Ind AS. So is the fourth condition met? The ultimate
Yes.
pay is supposed
Yes,
to be
sir.
in console as per Ind AS. Great. Then he says company C is an unlisted company and is not in the process of listing. Can I say another two conditions are met?
Yes, sir.
And then it says 60% of the share capital of C is held by company A, as can be seen in the diagram. And it says the
Okay.
balance 40% is held by other outside investor. Company A does not object to company C not preparing consolidated financial statements. Whether company C is required to make the consolidated financials as per the requirements of Ind AS 110. Now, my question is, do we need a NOC from company, the outsiders other than A? Because
Yes, sir.
C is not a wholly owned subsidiary of A. So would I need an NOC from the other 40% stakeholders?
Yes, sir.
Yes, it is.
Yes, sir. No objection to be received from the 100 percentage, not only
Absolutely.
from the
Because,
parent. The outsider
absolutely.
also we
Because
need to get it.
wonderful indeed. Because since company A is got only 60%, so we need to see that those 40% people should get an NOC. So we can say C in this particular case will be able to get the benefit if NOC from 40% is obtained. If you're able to get the no objection from those 40% stakeholders, then yes, C will get the exemption because other three conditions are getting met. So the only thing is the NOC. Let's look at the scenario number B. Assume the same facts in scenario A, except that balance 40% share capital is held by company B. So this company B is got, you can say, a 40% stake in this company. Now, would you need an NOC? State whether C is required to inform the other owners B of its intention not to prepare a console?
No, sir. It's not required because the ultimate parent company is having the full control.
Absolutely correct. So we can say in this particular case, A, you can say directly and indirectly has got 100% stake in C because through B, he gets a 40% stake and he's got a direct 60% stake. So since he's got 100% direct plus indirect, nano C not required. So we'll just make a mention on this. So we can say in this particular case, A has direct. A has got a direct, you can say 60% stake in C, and A has got indirect. A has got indirect 40% stake in C, and this is through B, that is through the subsidiary B. So since A has got a direct indirect percentage, which makes it a total of 100% in C, so we can say NOC is not required. NOC is not required in this case. So all the conditions will be met. So C will get the option of not presenting a consolidated financials. Wonderful indeed. So I think that's also pretty simple and straight. Okay, let's I think go to the next one, the question number 7. So we're again given a similar structure where company X has got 100% stake in A and it has got two subsidiaries B and C. Does that make it a chain holding?
Yes, sir.
Yes, absolutely. So even just to remind you, in the previous question, there was no status of investment entity. So we're not looking at the case of para number 4B. Now, let's look at the scenario number A. It says, following is the structure of a group headed by company X. It says company X is a listed entity in India and prepares a consolidated financials as per Ind AS. One requirement met. And then it
Yes.
says company A is an unlisted entity and is not in the process of listing. So another two conditions met.
Yes,
And then
sir.
it says company X does not object to company A not preparing consolidated financials. Whether A is required to prepare a consolidation as per the requirements of 110. What do you say?
No,
It's
sir,
an
it's a choice.
option.
Option,
Yes,
choice.
absolutely. Because in this particular case, NOC is not required because X has got a 100% stake in A. So we can say there is an option available to the company A. Scenario number B, I think it's quite similar to what we did in the previous question number 5. Assume these same facts in A, except that X is exchange in foreign country and it prepares a financial statements in accordance with the gap applicable to that country. So do you think in this case A gets a choice?
No, sir.
No
It's
choice.
mandatory because it's not preparing as per the Indian accounting standard.
Yes.
Absolutely correct. So he gets no option in this particular case. A is required to present a consolidated financials. So I think all these examples were based on the concept of para 4A, which is not difficult because in all these cases, you can see the chain holding. The only input to be seen is the four conditions, and the focus mainly is on condition one. I think looking at the fact that it's not listed or not in the process of listing is not a big deal. Even looking at the ultimate parent is presenting console as per Ind AS is not a big deal. The main focus is looking into the condition one, where you need to see that do we need an NOC or not, where we need to see that the percentage is held not by an individual. So the two learnings which you get out of this is in condition one, the stake should be held by the entity and not individual. In condition number one, we need to see that NOC is required in which cases or not. Because as a parent, we saw that if you got direct indirect percentage, then in that case, NOC not required. Now let's go to the next one, which is going to be based on the concept of para number 4C. Okay, there is one more input out here. Let me, I think, first crop this up. So there's one more scenario, which is, I think, pretty straightforward. Then I can just push it forward. It says if there is an individual, I think we know the answer already, that you don't get an exemption. So I think I'll hide that out. Okay, good to go. We can see this visible.
Yes, sir. Visible, sir.
Okay, now this is interesting. I would say this is one of the best questions, I guess, which I see available in terms of the scope of the standard, and it is given in the education material, which is on Ind AS 110. But it's a brilliant question indeed. So let's, I think, first look at the inputs carefully. So we can see one thing very clearly that PQR is a non-investment entity. And I'm given that XYZ is an investment entity. And I can see that as far as A Limited is concerned, in this case, again, it's a non-investment entity. And as far as B Limited is concerned, it is again a non-investment entity. So in this particular case, we are now looking at, in view of the above structure, whether PQR and XYZ. So we're looking at the company PQR and we're looking at the company XYZ. Are they required from their respective reporting standpoint to present a consolidated financials? For this purpose, assume that the other conditions which are mentioned in the para number 4A, that is 1, 2, 3, related to exceptions are satisfied for the above entity. Now, let me first ask you a few questions before we proceed. Can company PQR avail the benefit of those four conditions in 4A? Can the company PQR on the top of the chain avail the benefit of those, four conditions in 4A?
Yes, sir.
Are you sure? We said in terms of 4A, the benefit goes to the middle company.
Yes, sir. Only middle company only, sir. Not the PQR first
So
company.
I'm talking of PQR, the top company.
No, sir.
Can
No,
this
sir.
company? No. So can I say, can this company avail the benefit of 4A? The answer, of course, is no. Now let's, I think, focus only PQR at the moment. Can he
Okay,
get
okay.
the benefits in terms of 4B?
4B also no, sir, because it's not an investment company.
Absolutely. So can I say, as far as PQR is concerned, in a chain holding setup, the benefit goes to the middle company. So he cannot avail the benefit because he's a top company. In terms of 4B, situation number two, he is not an investment entity. So in this particular case, we can say he is not going to get the benefit. So can I say for PQR, it's going to be a mandatory consolidation? Am I right?
Yes, sir.
Correct. Now let's go to the company XYZ. So first of all, let's consider he is in the middle company. Can he get the benefit of 4A?
4, yes, sir.
And if I want to apply the parameters in terms of 4B, can I also do that?
Yes, sir.
Correct. So can
Because
I
it is
say
investment company.
yes? So we can say he can get the benefit of 4A also, and he can be evaluating para 4B also. So if there is a contradiction in 4A and 4B, what will prevail?
4B.
Wonderful indeed. So
Yes,
I
sir.
think let's first of all begin the evaluations from the point of view of 4A, and then let's begin the evaluations from the point of 4B. In terms of 4A, we are stated in the end, assume the other conditions mentioned in para 4A, that is, the remaining three conditions are met. So can I say the ultimate parent is got 100% stake?
Yes.
So
Yes,
if I
sir.
look at the fourth condition, what was the fourth condition? Because 1, 2, 3 is met. So what is the fourth condition? Can I say PQR is presenting a consolidated financial statements as per India's? And can I say he is mandated? So he would
Yes,
be
sir.
presenting a console as per the India. So all four conditions will get met.
Yes.
So can I say in this particular case, the four conditions will get met. So we can say he would get a
Your
choice.
choice. Okay.
Now let's go to the para number 4B. So let's go with the one. Tell me what is the first step to be seen. Before that,
Yeah.
are you going to evaluate this with reference to A and B? So are you going to run the three-step model for A and B separately?
Separately we run, sir.
Absolutely. So I think let's do the evaluation. Rather, you do the evaluation and tell me that would company A be required to be consolidated or B be required? Which one yes, which one no, or both yes or both no?
Sir, A Limited is required to consolidate because it's a non-investment company and also is carrying the service that related to the investment company XYZ.
Wonderful. And what about B?
B is not required to consolidate because it's a non-investment company. So no, no,
Right. And
no.
nowhere I'm giving
Yeah.
the services the same, so that would not be consolidated. Good, very good. So I think let's look at the evaluations of A as well as B separately. Let's run the three-step model. So we are very clear with the inputs with reference to both A and B. So I think first of all, we are putting the question, tell me which company are you going to look at in step number one?
B. No,
No, no,
XYZ. XYZ.
XYZ. So we put the question first of all, is XYZ supposed to be an investment
Investment.
entity? I'm putting it as IE. The answer is yes.
Yes.
So we go to step number two. Then in step number two, we're putting the question for A, is that an investment entity?
No.
Yes.
No, it's
Step
not an
number two.
investment entity.
No, 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 no. It's not
So
investment company.
it is not an investment entity. So had it been investment entity, would XYZ get a mandatory exception?
Yes. It would have
Yes.
got.
So now we go to the step number three because A is not an investment entity and we see that it is carrying on the services related to XYZ. So we need to see that is the services related to XYZ? And the answer in this particular case is yes.
Yes.
Yes. Then the CFS is required.
Yes, so in this particular case, we can say the consolidated financials are required to be presented by company XYZ. Now let's go to the references of evaluating the three steps in terms of B. can I say the first question, of course, remains the same, that XYZ is investment. And as far as B Limited is concerned, is that an investment entity? No, again. So we go to the step number 3. I am nowhere given that the work of B relates to XYZ. So can I say I'll presume it is not? And if it is not, then it is not going to present consolidated financial.
Yes,
So
sir.
in this particular case, the conclusion which comes in is that XYZ in this particular case is being asked that you are not required to consolidate A and you are required to consolidate B. Now tell me, looking at 4A and 4B put together, which companies will XYZ consolidate?
XY will consolidate to.
Does he get a choice in terms of A, or I tell him, boss, you cannot consolidate A? Looking at both the inputs, does he get a choice in terms of A, or can I tell him you cannot consolidate A? 4A
A
is
has
giving a
to.
choice and
Yes.
4B
You
is telling
cannot
him you
consolidate
cannot.
it.
It
Cannot
cannot.
consolidate.
So can I say it cannot consolidate? And let's look at B Limited. So para number 4A is giving again a choice and B is saying you need to consolidate. So he gets a
You
choice
need
or I
to
tell him
consolidate.
you have to
You need to.
consolidate. So we'll tell him that you have to consolidate this particular company. I hope you got the picture absolutely clear in terms of A and
These
4B.
the last this conclusion I couldn't get.
Okay, I'll just put it again. If you remember, I said for number 4B overrides 4A.
Yes.
So which means whatever conclusion you've drawn on the basis of 4A will take a back seat. So 4A is telling that you get a choice to consolidate A and B. So I'll say, I'm not concerned. Let's keep it aside. So whatever conclusion comes on 4B is the final answer. So what is 4B telling me? That as far as A is concerned, it has to be consolidated. Sorry, it cannot be consolidated. So I will tell company XYZ, you need to listen to 4B. If you need to listen to 4B, you cannot. Okay, sorry, it is the other way around, I think, is it? Oh, I think I've written it the other way around. My mistake.
Yes, yes, sir. Yes, sir. Written as the other way around.
Oh, that's the reason I think somebody asked me to repeat that. So this is going to be consolidated and this is not to be consolidated. So basically, you can say in a nutshell, the conclusion of para number 4B is the final answer. Because
Yes,
whatever you
sir.
conclude on 4A will take a backseat because 4B will override clause number 4A. Right? Got the
So
picture?
whatever the exercise that we are doing, sir, it is with the point view of B Limited only, XYZ Limited only. See,
Yes, middle
CFS
count.
you can make. That's all.
Yes,
You can
because
do.
we have to evaluate
Yes.
both from PQR and XYZ. PQR, we did the evaluations and we said it is getting nothing because neither 4A, 4B is applicable. So we can say if you look at the top company, he will consolidate all these companies.
Okay.
PQR is going to consolidate all these companies because he gets no choices and no mandatory exceptions. But as far as XYZ is concerned, he will be consolidating only A. That's it.
In this exercise A Limited, you are saying at the last, yes, CFS is required. That means
Yes,
XYZ is doing that consolidation of it
correct. Correct.
Yeah, it is a mandatory to do the consolidation for XYZ with the A, but
Yes.
B
So
it's not required.
yes, so I think let me just put it in a nutshell to avoid any confusion. When the question says, in view of the above structure, whether PQR and XYZ are required from the respective reporting standpoint to present console. So if you tell, is PQR required to consolidate? Yes. And can I say he will consolidate all these three companies? Let me make it clear that PQR is going to consolidate all these three companies because when you consolidate, you need to consolidate all the subsidiaries, which are held directly, indirectly. This is a chain holding for PQR. So PQR will be consolidating all these three companies. Next, if you look at the middle company XYZ, he will consolidate only A and not B Limited. And not B Limited. So when he's going to present a consolidated financial, let me also add that A will present investment in B at FPTPL. Just to add that point. Because if XYZ will not be consolidating B, he would be presenting the investment in the consolidated financials. and that investments will be measured at fair value through P&L in that particular case. I hope my point is very clear on that, right?
Yes.
Okay, perfect. So this takes care of the concept of scope. Very interesting indeed, because you can get some good questions on this even in terms of MCQ. So I thought, let's also revise the concept of scope as well. Now let's, I think, go on to the next area of revision, that is assessment control, which of course is been very less frequent in the exam, but I think we should not take chances, because now since you get MCQs, one could be testing your knowledge through MCQs on that area as well. So I think let's take the journey forward and let's have a look. Yes.
Sir, in this question, suppose a parent, ultimate parent is investment entity, then it is required to mandatory consolidate the CFS, sir.
You mean to say that PQR is an investment entity? Then PQR is not required to present consolidation. We'll mandate him not to present.
Okay, sir.
So I think just a small little input, so that also adds to the layer. I think, quickly give you another insights as well. I'm just thinking, a small little mind map at this stage will help. So a little consolidation chart. Shall I do the honors of giving you a little more clarity, icing on the cake?
Yes, sir.
Okay.
Yes, sir.
So I think let's get some insights from your end on this. I'm just looking at now broadly two combinations. I'm looking at the concept of para number 4A. When there is no chain, this is like a super mind map, and let's say there is a chain. I always thought, even as a student, that the best idea of making revisions is to make consolidated mind maps, which contains all the permutation combinations so that it avoids any kind of confusions in life. But that can be dangerous as well. And then I am looking at the para number 4B. So let me now ask you quick questions so that we can make a interesting mind map on this particular area. So this is my mind map on the scope, summarizing the inputs of whatever insights we have learned. Now, question number 1, first of all, to put across is para number 4A mandatory or is it optional?
For number 4 is optional, sir. It's not mandatory.
Absolutely. So let's put it out here that this is optional. What about para number 4B? Is it optional or is it mandatory?
Mandatory, sir. It's an exception.
Wonderful indeed. So this is mandatory in nature. Now let's proceed with the para number 4A first of all. Can I say in terms of para 4A, there is a company A and there is a control in B. Does this para give any kind of exemptions to A?
No.
No, sir.
Because there is no chain. So can I say para number 4A in this particular case is not going to be applicable? Anybody's got any doubt on this particular aspect? Is the first matrix clear? You can see para 4A without a chain is not applicable. 4 permutation combinations working. Okay, now let's go to the next one, that I am looking at a chain that is A in B and B in C. Now tell me first of all, if we are looking at para 4A, we're looking at for which company, A or B?
B.
Correct. So the focus is in terms of the company number B. Because in a chain, your focus is on the middle company. So can I say one thing very clear, that A can never get the benefits of 4A. A top company can never get the benefits of 4A. Is that statement correct?
Correct, sir.
Yes.
Absolutely. Now, can I say in terms of the company number B, if this is able to meet the 4 conditions? So if the 4 conditions are met or if the 4 conditions anyone fails? Tell me if the 4 conditions are met, what is the status of consolidation? Mandatory, choice?
So it's a choice. If the 4 condition is met, is a choice. If 4 condition is not met, it's not required to do the consolidation.
No,
It's required. It's required to do that. Yes.
Yes. If any one condition fails, you're required. If all
Yes,
this
sir.
is met, you got a choice.
Right,
I
sir.
hope I'm very clear on the para number 4A combinations now.
Sir, If 4 conditions are met, B will get a choice.
Yes.
If anyone fails, A will be doing that CFS, no, sir?
And even B.
Even B also has to do.
A will consolidate BC and B will consolidate
Okay.
C.
Okay, sir. Okay.
Now let's go further and let's have a look at the para number 4B, where again we are considering that there is no chain. Now tell me, can A get the benefit? Now, can A get the benefit of 4B?
Sir, it's a depends, sir. If a company is a investment company, then it will apply. If no means it cannot apply.
Very good. So we can say we will look into the status that is it? It's not a three-step model. It's not a three-step model. So we'll say, is it an investment entity? This is the only question to be put across. If you say yes, can I say A is not required to make consolidation? And can I say if you say no, then A is required to make consolidation? Correct? Is this
Yes,
also
sir.
clear?
Yes, sir.
This is no chain. So the status of A is completely dependent upon is the investment entity or not. Now let's go to the next one, which we've been looking at. So we have got A, we've got B, and we have got C. So let me first ask you, is A going to look at the same status which I gave you here?
Yes.
Yes,
Correct.
sir.
And as far as B is concerned, are we going to apply a three-step model?
Yes, sir. Again, we going to ask the question
So in
whether it
this
is
particular
a.
case, this is the case where you apply the three-step model which I gave you. So the
Yes, sir.
three-step model is going to be applicable only in a chain, only in a chain where you're looking at the middle company status. So now you know where the three-step model is seen. If there is no chain, you just need to put single question liner. But in terms of a middle company, you need to apply a three-step model. And you know the status of the three-step model, but let's still ask you some combinations. So if you say that A is an investment entity and you say B is also an investment entity, can I say everything depends upon is the work of B related to A or is the work of B not related to A? Is my thoughts correct?
Yes, sir.
Because if you say A is investment, B is investment, because B is not investment, consolidation will happen. So in this particular case, we are saying that if A, B are investment and C is doing the work related to A, then in this case, does B consolidate? Yes.
CFS.
And in the other case, no.
No. Exemption.
Right? I hope now this mind maps give you all the inputs at rest.
Yes, sir.
Right. And in any case, if A is not an investment entity, he will be consolidating B and C. And if B is investment entity and meets the parameters of related to A and all, accordingly, he will consolidate C or not consolidate C. Okay, so that was a quick mind map in terms of understanding the scope of the standards. Your focus needs to be very clear that you're looking at for A or for B, and whether it's a chain or there is no chain, accordingly, how your thoughts would trigger. Comfortable, I guess, with the entire inputs now?
Yes, sir.
Sir,
100 percentage.
Wonderful
sir, in
indeed.
case of
Yes.
sir, in case of para 4B,
Yeah.
It is mandatory to not prepare, sir, but it is mandatory
Yes.
to exemption, sir. Yes,
Yes,
sir.
we said that bit in the initial itself. If you remember, I made a chart and I said in terms of para number 4B, it is mandatory.
Not
The
to
para number
prepare.
4B tells you that you cannot consolidate. If you meet the conditions of 4B, if there is
Okay,
no
sir.
chain, A is an investment entity, I'll tell A you cannot consolidate. In
Sir,
a
then
chain
my
holding, you look at B and it meets the three-step model, I will tell B you cannot consolidate.
sir, then suppose it is a listed company, then how the investor will get information, sir?
But the problem is, okay, I think now you're looking into the logic why the investment entity is given the choice. Why is it mandated? You see, as an investment entity, my basic purpose is that I take money from unrelated investors and put it in different companies. So if I'm going to get a control in the investee company, is it, by something by default or not? Because my objective is giving a capital appreciations and return to my investors. So they give in money and I, park that money in different companies and I am getting a control. So do you think that control is coming by default? What is your input on that?
Yes, sir.
As an investment entity, 10 people gave me money to, give them capital appreciation and growth. So I invested money in certain companies and I get a control over certain companies for the money invested on behalf of those investors. So do you think it is getting a control by default technically?
Yes, sir.
Yes. So if I'm getting a control by default, why should I be, forced to consolidate? I have no intentions to get a control. The concept of control is that you're intentionally trying to control a company. But in this case, I'm not trying to control a company. So the standard setters thought that for this kind of a company, which has got a survival of an investment entity, the basic objective of an investment entity, don't force them to consolidate because they are not consciously getting a control over companies. Their mere objective of, investing in companies with a higher percentage stake is only capital appreciation. So there's no point telling them to consolidate.
Sir,
Consolidation is an exercise where I'm, consciously planning to expand my operations and getting control over group companies to expand my operations. So I would be required to present my strength in the form of console, but not for investment entity.
yes,
Right?
it will be like a closely held company, sir, only.
Yeah, I mean, in the sense that, it's like, you tell me that, are you interested in getting a control in this company? I said, no, 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 I'm not interested in getting a control. My mere objective is capital appreciation. So I don't want to control them. I don't want to take decisions for them. So the basic objective is that I've invested with the capital growth in hand. So the real essence of consolidation is that, you're intentionally investing in company and you're intentionally getting a control over the company because you need to get the power to direct them. You need to get the power to direct the relevant activities of their businesses. So the idea of, telling investment company not to consolidate is because that company is invested by default without any objective of actually obtaining a control. So let's not make life complicated for them. Let's tell them that, boss, you can, an investment entity will be reflecting all the investments at FPTPL. So their measurement basis for all investments automatically will be a fair value through profit and loss, which will increase a volatility in their P&L because all investments will be fair valued and all the gains and losses will be captured in the P&L and which will consequently impact the earning per share of the company as well. Right. I hope my thoughts are very clear now.
Okay, sir. Thank you, sir. Clear.
You're
Yes,
most
sir. So actually, the investment is a passive income purpose, not to control or any main activity to do that.
exactly, exactly. So the intention of the standard setters is being on the spirit that let's not force these companies which are having an investment with a capital appreciation return perspective. Okay, so this is one input done. The scope is discussed. Now we are going to go to the next area of discussion, and that is the assessment of control situation. So as I said, this area could also, if you look at the frequency, you might say, this is not a very great area. But of course, we need to, make revisions and do that as well. So we will not get into the depth of the control assessment. We'll just take an overview of things to get the finer inputs clear. So let's go with the second objective, that is control assessment. Now, as I made a mention earlier as well, as we started off with this particular standard, I very clearly made a mention that control assessment is not a rule-based assessment. It is not based on the fact that as an investor, you've got more than 50% stake, so you get a control. It is something which is principle-based assessment. So this is not rule-based, but principle-based. It is not supposed to be a rule-based assessment, but it is supposed to be a principle-based assessment. So I'm not going to go through the nitty-gritties, but I'm just going to make quick revisions on the concept. Then we've got one or two small case studies. One of the very comprehensive case studies, which is there, come in one of the revisionary test papers. We'll look into that case study as well. So let's first broadly revise the concept. So what I have done, I've again divided the control assessment in terms of a three-step model. Oh, not again. My, friend would ask me, sir, I've actually kept your name as a three-step model.
I have not kept it, sir. I heard it. You are famous by that name, he said. He has not kept.
Three-step model. I've actually
Sir,
called these models also nicknamed them as 3D three-step model, though I don't write it in front.
sir, also I am thinking now I'm going to revise that in-depth three-step model.
Okay. So let's, I think, have a quick look in terms of what are the three steps to be seen in terms of control assessment. The step number one. The step number one is to see, you can say, three sub-elements when you look at the concept of control. So the first thing which I'm going to see in terms of the control assessment is power.
Power.
And when I look at the power, there are going to be three sub-elements which we will see. One is called existing rights.
Yes, sir. Existing right give the current ability to direct the relevant activity.
Very good indeed. So we've got the second element that is called current ability. And the third element of power is supposed to be relevant activities. So we'll take a little inputs in each of these elements as well. But first we need to understand that power is supposed to be a combination of three elements, that as an investor, you've got certain existing rights, which will give you the ability when the need arises. The current ability is not as of today. The current ability is when the need arises. Will these existing rights, give you the ability at that stage in order to take decisions on relevant activities, which could influence the decisions, which could influence the profits of the investee. The second parameter in terms of control is exposure to variable returns. Exposure to variable returns. As
Yes,
an
sir.
investor, you need to be exposed to variable returns of the investing. And finally, we need to prove a linkage between the step one and two. So we can say the third step is linkage in terms of power in step number one and linkage in terms of step number two, that is return. Now, basically, if I just look at the evaluations of this, if your step number one is a yes, your step number two is a yes, automatically the step three is a yes. In a given situation, if you're able to prove that yes, there is a power, and yes, I'm exposed to variable returns as an investor, linkage is a yes. In a situation where you say, yes, there is a power, but you're not exposed to variable return, the linkage automatically is gone. So third step technically would not require evaluations, because if this is a yes and this is a no, automatically the third step becomes a no. So I think what we need to consider is the understanding of the step number one, that is the three elements, and the step number two. And step number two is not very difficult indeed. And I'll come to that, I think, one by one. So let's, I think, discuss first of all the elements of power, that is existing rights, current ability, and the relevant activities. So I'm just going to give you some quick charts on the assumption that you've already made your revisions. So I'm not, trying to tell you the concept. I'll take a quick revisions of these three elements with you. So let's begin with the first element, and that is called existing rights. So under my step number one, that is the concept of power, I'm looking at the element number one, which is called existing rights. So let's create a summary chart, understanding what kind of existing rights do we make a reference in step number one. So first of all, let's, I think, recall that there are two kinds of rights which are there in terms of this standard. One is, you can say, the right to appoint or remove the KMP. And the second is what is called a voting right. So when you're looking at the rights, in this particular case, the rights are of two categories. One is you've got voting rights in the investee. The second is you've got the right to appoint or remove the KMP. Now, the right to appoint or remove the KMP on a standalone basis will not get you control, but I can say it's more like an add-on kind of a right. That you've got some voting rights in the company, and along with which you've got right to appoint and remove KMP, so that could act in a combo. Now, when you consider the concept of voting rights, there can be a numerous number of combinations. Either you've got majority voting rights in the company, or you've got less than majority voting rights in the company. But that does not mean that if you've got less than majority voting rights, you cannot get a power. You can get a power in those cases. And even if you've got majority voting rights in the company, it is not necessary that you will get a power. So let's create a structure. So we can say when you're looking at the concept of existing rights, we can say there will be two kinds of rights. One is we can say the voting rights. So one is we can say is the voting rights, and the other is we can say the right to appoint or remove. The right to appoint or remove key MP, key management person. So this is not a very important right because, as I said, this is more like an add-on. So let's not concentrate on that. Now, when you consider the concept of voting rights, your mind should function on a structure like this. That do you've got majority voting rights in a company? Or you've got less than majority voting rights in a company? So we need to see that you've got majority voting rights in a company or you've got less than majority voting rights in a company. Now, if you've got majority voting rights in a company, by default, you get power. But you need to see that there's also
Yes,
a
sir.
possibility as an investor, you've got majority voting rights, but still you don't have power because it is subject to permissions. Because whenever you need to exercise those voting rights, you need to take permissions from the court or other regulatory authority. So we can say there will be two kinds of situations in this case as well. When you've got majority voting rights, we can say one is that in this particular case, you say, is there a power? So by default, yes.
So it's implied unless otherwise
Yes,
mentioned.
absolutely. So we can say that if you've got majority voting rights, the default we will say, yes, you've got a power. But there is a little exception that you've got majority voting rights, but still there is no power. And that is when it is subject to permissions. Because you've got majority shares, but you need to take the court approval, for example. So in those particular cases, that would be stated clearly in the question. So your thought needs to work that, okay, you've got majority voting rights. Is there anything to the contrary? No. Yes, I've got power. I've got majority voting rights, but explicitly mentioned you need to take a permission from the court. I've got no power. The next input is when you've got less than majority voting rights. In this particular case, you can get a power. You can still get a power. So this is, I think, the interesting element which requires an evaluation of judgment. The company has got less than majority voting rights, but still it has got a power, and that could be attributed to other combinations. For example, as an investor, along with the less than majority rights, I've entered into a contractual agreement with some other investor, where me and the other investor jointly act together. Or there is a possibility that I've got some potential ordinary shares in the investee as well. Along with less than majority voting shares, I've also got the right, a potential voting rights, convertible debentures or preferred stock through which my majority stake might get converted. Or there is also possibility that along with the majority voting rights, you've also got the right to appoint or remove the KMP. Or there is a possibility that you've got less than majority voting rights, but your pattern of holding is such that nobody else comes for the meeting. You alone is the single largest investor in the company. Though you are below majority, but you're still a single largest investor of that company. Or it could be a combination of all these factors put together. So I would say there will be a total of 5 elements which you're going to see in this case. When you see it is less than majority, you are going to see a total of 5 permutations and combination. So for example, along with less than majority, so that means along with the less than majority, you've also entered into a contractual arrangement of acting together with another investor. Is this going to give you a sure shot power? If
Yeah,
you've got
definitely, sir.
authority and you
Yes,
enter
sir.
into contractual arrangement, absolutely yes.
Say
As an
example,
investor,
yeah. If the
as an
investor
investor A,
A has 20%,
you
B has
enter into
20%.
agreement with B and you act together, so you basically got a control. Yes. So we can say in this particular case, it is I would say control will definitely exist. Definitely exist. So naturally, this kind of situations may not be given to you because this is anybody would reach a conclusion that yes, there is a power. Because if you're entering into a contractual arrangement with another investor where he agrees to act jointly with you every time, then there is always an implied control. The second case is that along with the less than majority, you've got certain potential, you can say potential shares held. Is this going to give you a sure shot power, or do you think it all depends upon whether you will exercise these potential equity shares or not?
Yes, sir. It depends.
Correct. So in this particular case, it is something subjective in nature because you'll have to make an evaluations and decide. Because if you've got, let's say, convertible debentures, you may or may not exercise those convertible debenture. So can I say it would depend upon the situations, whether it is in money or is it out of money? Is it deeply in or deeply out of money? It's going to be a complete subjective affair. I know one thing, that I've got less than majority shares, and once these potential ordinary shares are exercised, I might convert into a majority voting rights in those cases. But whether I will exercise those potential voting rights or not is something which is subjective, would depend upon the status. As I said, it is in, out, deeply in, out, money, whatever. The next is less than majority shares, but you've also got the right to appoint and remove the KMP. So we've got the right to appoint, or we've got the right to remove the KMP of the company. So do you think this will sure shot give you a power, or this could also lead to subjectivity?
Yeah, it's also lead to subjectivity, further calculation required.
Correct, because the right to appoint or remove the KMP is again something which might be taken away by you. The other investors may take away the right of appointment and removal. So this is also going to be subjective. It all depends upon the facts of the case in this case. The third, I said that you've got nothing more. So there is nothing more. There is nothing extra you've got. So you've got less than majority voting shares and you've got nothing extra. But the main issue is that you are the single largest shareholder of the company. There is no other investor as bigger as you. So can I say nothing extra in this case means that you are the single largest investor. So you
Yes,
are the
sir.
single largest investor. So basically, you go to the company, other people's really don't even go to the company. So, but is this a confirmed case of power, or again subjectivity could arise?
This is again subjectivity could arise, sir.
Absolutely correct. So this is again subjective. You cannot say. The only case where you can say is a confirmed case of control is entering into a contractual arrangement. In all of the cases, it'll be subjective. It all depends upon the facts of the cases. You'll have to evaluate and decide. There is nothing concrete one can give you. And it could be a mix of permutation combinations of all these factors as well. So this just gives you a quick summary chart. As I said, we're not, understanding the concept. We're just making a summary chart just to get the fundamentals clear before we proceed with the questions. That this is a summary chart in terms of the power element, which is only on the concept of existing rights. Only on the concept of one element, that is existing rights. So to get the thought process clear, just to connect the dots once again, when you are considering the element of power, your mind is working on existing rights, your mind is working on the current ability, and your mind is working in terms of, you can say, the other one, relevant activities. Now, in terms of the existing rights, we need to understand that basically there are going to be two kinds of rights. One is called the voting rights, and the other is the right to appoint and remove KMP. But as I said, that this right on a standalone basis is not strong enough to give you power. So a basic concentration in terms of power is going to be on the voting rights. And when you consider voting rights, there will be broadly two kind of situations that as an investor, you've got majority rights. It goes without saying that if you've got majority rights, you will get power unless there is anything stated to the contrary. The input which needs a judgmental assessment is when you as an investor has got less than majority voting rights, you need to see what kind of combinations are there. Did you enter into a contractual arrangement with somebody? Do you have potential ordinary shares with you? Do you get the right to appoint or remove KMP? Are you the single largest investor, or is it a blend of combinations of all these things? And that will decide the fate whether we get a power or not. Right, friends? So that is the element one. Let's go to the second element.
Sir,
Still on,
I could relate that less than majority voting rights related to the state election and central election, when they don't have the majority, so this all situation will arise.
that's what you call coalition government.
Yes,
That's what I call contractual arrangement.
yes, sir.
Absolutely. Good to relate it with the practical world as well to get more good insights. Okay, then we go to the step number one back again, and now we are looking at the concept of power with the second element, and that is, you can say, current ability. That is the second element of power, that is current ability. Now, as I made a mention earlier as well, that the current ability is not supposed to be as of today. The current ability is when the need arises. So we need to see, because you can say the control assessment is something which is futuristic in nature. We are looking at that in a given situation when the board meeting would take place, when the shareholders meeting would take place. So at that particular stage, would you be in a position to exercise your power or not? So the only thing which I'm putting is the current ability when need arises. So when the need arises, so you need to see that as of today, you may not get the ability to exercise power. So for example, if a company has got potential ordinary shares, and these potential ordinary shares will get converted before the shareholders meeting will take place, where decisions to take relevant activities will be taken. Do you think I get a power? Do you think I get a current ability?
Yes, sir. It depends on situation.
Yes, so I can say that, today I've got potential ordinary shares, but I know that before the meeting to take decisions on relevant activities will be taken, these potential ordinary shares, which are deeply in money, I'm definitely going to exercise them. So I
Yes,
will get
sir.
the ability to exert my power at the time when the need arises. That is the main focus point. Then, in terms of the step number one further, we've got the third element, and that is relevant activities. So power is got another third element, and that is relevant activities. So you get the existing rights, and that gives you a current ability. But what is most important is the current ability to do relevant activities. As an investor, I should be in a position to take decisions which could influence the profits of the investing. So what is important is the decisions which I can take as an investor are something which will impact the profitability of the company. So when you say it is relevant activities, we can say decisions which will impact. Decisions which will impact. Decision which will impact profits of investing. Decision which will impact the profits of the investee. For example, is the fixation of selling price a relevant activity? As an investor, if I am in a position to fix the selling price of the asset, do you think that is a relevant activity?
Yes, sir. Definitely.
Definitely, yes. For example, as an investor, if I am responsible to decide the business model in terms of managing the financial assets of the company, do you think that is a relevant activity?
Yes, sir. Definitely.
So let's say, for example, as an investor, I'm responsible in terms of deciding the, you can say the purchase and disposal of the non-current assets. Do you think I am having relevant activity decisions?
Yes, sir. Citing. Yes, sir.
Absolutely. So the standard has given us some examples of relevant activity, which we discussed also when we did all these things in detail, that what are the relevant activities, but any kind of activity which could influence, you can say the profitability of the investee is something which is relevant. So what you need to see in nutshell in terms of step one is that you've got some kind of rights as of today. Mind the words, you've got some kind of rights as of today, which will be in a position, which will give you a position that when the need arises to take decisions on those relevant activity, you should be able to exercise your rights. You should be able to exert your power. So rights need to be present as of today. So you've got something which is in hand today, but that's going to be useful when the need arises, not today. That when the meeting to take decisions on those relevant activities will occur, you would be in a position to dictate at that stage. That's what power is all about. And then comes the second step, and which is exposure to variable return. Then comes the second input, and that is exposure to variable returns. As an investor, I should be exposed to variable returns from the involvement with the investing. So I always give two examples in terms of the fact that as an investor, you are exposed to variable returns or not. So let me give you the same example again. Let's consider two situations, and let's say that as an investor, are you getting exposed to variable returns or not? Let's consider two permutations and combination, just to give you the main insight on step two. So when you're looking at the concept of power, power has got three elements. So when you're looking at the concept of power, power we said has got three elements. Existing rights, let's put it as ER, then current ability, let's put it as CA, and relevant activity, let's put it as RA. So let's give you some inputs and you can decide. Let's consider that as investor, as an investor, I've got majority voting rights. Can I consider these majority voting rights as an existing right?
Yes, sir.
Undoubtedly, yes. Can I say they will definitely give me the ability to direct the relevant activities when the need arises?
Yes, sir.
Because if I am the majority stakeholder of the company, then when a meeting occurs, I am the majority stakeholder. So what I decide, everybody needs to listen. Then I'm looking at the exposure to variable return. Since your majority voting rights is coming by way of ordinary shares, by way of equity shares, are you getting a fixed return or a variable dividends?
Variable dividend, sir.
Absolutely. So your exposure is definitely variable because you are getting a dividends from the investee, which will vary. So you're
Yeah,
exposed to variable return.
yeah. We studied this in a financial instrument.
Yes, that's right. And therefore, if the power and exposure gets a yes, automatically your step number three, the linkage also gets established. Because we said if you say yes, there is a power, and yes, you're exposed to variable returns, the linkage is there, and therefore you also get a control. Now let's look at another situation. Let us say your concept of power arises out of less than majority. As an investor, you've got less than majority voting rights. And let's say you've got some convertible debentures, which is potential ordinary shares. But let's say it is deeply in money that you will definitely exercise these convertible debenture as well. So you've got less than majority shares on the company, and you've got, let's say, a potential debentures, convertible debentures in a company, which if converted, and there is deeply in money that you will convert. Do you think these are both combined as existing rights?
Yes, sir. Even though the less than majority, yes.
Yes, because these potential shares, if converted, was going to give you a control for sure. And I'm saying it's deeply in money. Does it also give you the current ability to direct the relevant activity when the need arises?
Yes, sir.
Yes.
That's right. And what are you exposed to? Are you getting a variable return in the form of dividends and a fixed interest in the form of convertible debt?
Yes, sir. Export to variable return in terms of dividend, entitled to fixed return in terms of interest on dividend,
Absolutely. So
debenture.
you're getting a variable return in the form of dividend, and you're getting a fixed return in the form of interest, rightly said. But the standard very clearly gives us an explanation that this fixed return is considered to be variable in nature. They say that it is considered variable in nature. The fixed interest which you are getting is considered that you are exposed to variable return. It doesn't say that you're entitled to variable return. So we can say that you are entitled to a fixed return, but you are exposed to a variable return because I'm exposed to the credit risk of the investee. What happens if the investee tomorrow is unable to pay my dues? I'm running a credit risk of not getting the money. So the word which is more important is the word exposure. So we can say this is getting entitled. This is getting entitled to fixed return, but we are getting exposed to variable return because as an investor, I am exposed to the credit risk of the investee and I may not get the fixed return. So getting entitled is not important. Getting exposed is important in terms of step two, that you need to see that you are exposed to variable return. That's the point which I wanted to make. Which means effectively, if you consider all the situations when you get a power, I think to me, from an examination point of view, step number two will always be exposed to variable returns. And if you say yes to power, and if you say yes to exposure, then I think in terms of step three, the linkage automatically becomes a yes, and the control also becomes a yes. Right, friends, so that was a quick review in terms of the parameters as far as control is concerned. Power, which has got three elements: existing rights, current ability, and relevant activity. Exposure to variable returns, not entitlement. And then the linkage: power, yes; exposure, yes; linkage, automatically, yes. I hope you got the basic summary of the elements of control assessment clear.
Yes,
Yes.
sir.
Wonderful indeed. So I think at this stage, let's I think first give you a small break. Then I think we can do some practical questions on this area. There are two questions which are there as far as the area of control assessment is concerned. Then after this, we could start with the revision in terms of consolidation process, where we're going to spend good time. The next class, of course, is going to be devoted completely to the aspect of practical illustrations. Rather, I would say the next two classes is going to be completely devoted on the consolidation of balance sheets, income statement, and as I promised, I am planning to do one wonderful question on the consolidated balance sheet. I told you one question which contains a good number of adjustments. But I think first let's give you a break. Let's relax the minds and then begin back. Right, friends. So 10, 12 minutes, I join you back.
Okay, sir. Thank you, sir.
Thank you. Okay. I guess we are ready again to do some questions. Relax your minds. So we have done the summary chart in terms of the control assessment and where we've got the elements. One is power, which has got three elements, and then there is exposure to variable returns and a linkage between the concept of power and the exposure. So let's do some practical illustrations with you on this area as well. So let's have a look at question number 9 to begin with. So there is one line which I can show you later. So let's have a look at question number 9 on the assessment of control. So we given in this case, it says T Limited is carrying on the business of developing lightweight and medium weight guns for Indian defense industry. It says T acquired 48% of the shares in K, which means less than majority.
Yes,
A
sir.
company engaged in advanced research in weapons. T Limited acquired the shares in K to substantiate their position in the industry. The remaining 52% of the shares are held by key management personnel of the company, that is K Limited. The K management consists of 11 people who are experts in the field of advanced weapon and the core of the company. T Limited has the option to purchase the remaining 52% of the shares at any times by paying 6 times the market price. But on purchase of the share, it is highly possible that the key management personnel will leave the company. State whether T Limited has got a control over K or not. Let's concentrate only on the first part. So your insights in terms of the facts of the case.
Yes, sir. They have the potential voting things. At any point in time, they can purchase the remaining shares, and those people will go.
So you mean to say that T establishes a control over K?
Six time by paying extra.
So the question is whether T has got a control over K. So what is the assessment? Is got a control or no control?
No control, sir, because it's a 6 time by paying the market price of the shares is out of money. I think they may
Right.
not be able to purchase it.
And then also on the purchase, it is highly possible that they will leave the company. Correct?
Yes, sir.
Okay. So I think you're absolutely correct. So let me, I think, just explain that also to you. So we can very clearly see in this particular case that the company has got a 48% stake, which is undoubtedly less than majority voting rights. So in terms of majority voting rights, what is important is to see the other facts and circumstances of the case. Now he says the remaining 52% is held by the KMP of the company. And these are 11 people who are experts in the field of advanced weapons and core of the company. Now, let's understand one thing, that what is the basic objective of this company? You know, when T acquired a stake in this company K, the idea was basically that since they are engaged in advanced research in weapons, they will be able to create a good position in the industry. Now, the problem is that if you're going to pay 6 times the money, that is one, you're going to pay a premium, a huge premium in terms of acquiring the shares. Okay, let's even keep that one factor aside, that you're going to pay 6 times the money to acquire the shares. But at the end of the day, even after you acquire 52%, yes, on papers, you get a control of the company. But what is the basic idea of acquiring this company? That you should be able to carry out advanced research. And these 11 people, if they leave the company, then you are not able to get those people who will do that advanced research. So I think even by paying a premium and if they leave the company, then what's the point? So in this particular case, the company would not get practically no control of this company. So in this particular case, the company gets no control in this case. Then he says, what will be your answer if T has got a 51% shares in K? And I'm just reading the line, and they can start the research, development, production only with the stringent process of the defense ministry of the central government. So he says that even if you can do that, let's say you got more than 50, but you can be able to do all this research and development only if you're able to get the approval by the ministry, which is very stringent in nature. Do you think the control will be there or no?
No,
No,
no.
no, sir. No,
I
sir.
think in that case, you don't get a control in spite of the fact that you've got majority. But since you need to conduct research and development, you need approvals. And I said, one of the cases where your majority voting rights are there, but it is subject to approval. And getting this approval, it says, is stringent in nature. So the control will definitely not come. Okay, that's great. So I think that was one case study. Let's look at another interesting case study. This was in MTP October 19.
In this, sir,
Okay, now I guess let's take you to another case study. Let me just crop this. This is a bigger one. So we'll have to read the facts of the case very carefully. This is the only big case study which is seen in the revisionary test papers. I hope it's visible, right?
Yes, sir.
And there is some part I think I can maybe crop this, not an issue. I don't need this part. Okay, so let's come back and then we'll analyze. So now we need to read a lot of things. As we are going to read, you should keep evaluating the factors. I will also keep discussing those factors, ask you a few inputs as well. The idea is to basically look into this case study, applying the 3 steps which I gave you for the control assessment. This is the only good comprehensive questionnaire which is available. In fact, I can do it one thing. If this is not visibly too great, I can do one thing. Make it more visible to you in life. That's the advantage. Oh, this will crop up badly. My God, I can't do that. Sorry. We'll have to manage with this. Yes. Good to go. I think the visibility is good now.
Yes, sir.
Great. So that's a good idea to do that. So now let's, I think, read the inputs. It says Angel has adopted Ind AS with a transition date on 1st April 17. I'm just thinking, before I read further, is there a possibility that a company which transit to Ind AS, since accounting standards were based on more like a rule-based assessment, so is there a possibility that when there was no control under accounting standard and with the switch over to Ind AS, the control comes in? Is there a possibility? Considering that AS is rule-based and considering that Ind AS is principle-based, so is there a possibility that there was no control under accounting standard, but the same situation assessed under Ind AS on transition could lead to a control?
Yes, sir.
Undoubtedly, yes. So let's read it further. So I am given the inputs out here. It says Angel adopted Ind AS with a transition date on 1st April 2017. Prior to the Ind AS, it was following accounting standards notified under the company's AS Rule 2006, hereinafter referred as ICAI. It has made investment in equity shares of Pharma, a listed company engaged in the business of pharmaceutical. The shareholding pattern of Pharma is given. Now, there is some interesting pattern to be seen. Angel has got only 21% stake in this company. But there is another company, Little Angel, where it says, refer to the note number 2. Now it says Little Angel is a subsidiary of Angel under Ind AS, in which Angel has got a 51% voting power. A quick question to you. Can I say, considering that Little Angel is a subsidiary of Angel, can I add this 24% as a part of Angel? Can I indirectly say that Angel has got a 45% stake in Pharma?
Indirectly, it's not possible, sir, because only it has the 51% of the shareholding of the Little Angel.
No, but then you see, even with a 51% stake, it is got a control. So can I say, as far as this company Angel is concerned, directly, indirectly, it has got a 45% stake in pharma.
Yes, sir. That,
Yes, sir.
yes, sir, that we can say. I'm thinking about the non-controlling interest of the little agent. Is there any
Okay, okay. So
control
let me, I
dilution
think,
is there or not?
diagrammatically also let's have a look. So we can say there is a company Angel and there is a company Pharma. Or let's I think draw this like so. We've got the company Little Angel, and then we've got another company that is Pharma. So let's I think visualize this on a diagrammatic view to give a better input. So we are known Angel is got a 21% stake in Pharma. Angel is got 51% in Little Angel, and Little Angel is got 24% in Pharma. I think now it'll make more sense. So can I say Angel is got directly 21 and indirectly 24? So can I say he's got 21 plus 24 directly, indirectly, a 45% stake in the company? Correct?
Yes, sir. Yes, sir.
I know what you're thinking perhaps was the case that he's got 51% of 24. That would
Yes,
be
sir.
to calculate the percentage of NCI. Agreed. But when you establish a control, then in this particular case, I'll add the percentages directly. Let me be very clear on that. There are two aspects. Since you raised that interesting question, let me clarify. When you're establishing the concept of control, I would say let's add this percentage and this 21 and 24 directly without taking 51% of 24. Because establishing a control is just picking up the percentages as it is, direct, indirect, whatever. But when you're calculating the percentage of NCI, then I will say that Angel has got 51% of 24 indirectly. So there are two different elements. I hope that answers your question on that.
All right, sir.
Wonderful. Okay, so now coming back, so we again, has anybody done this case study earlier? Because I didn't do it in the normal classes, so I thought let's do that. So anybody's done this question earlier?
No, sir. First time.
Wonderful. Then it's going to be a good treat. Okay, so then it says, then there is Wealth Master, where it says note number 3, and note number 3 says that Wealth Master is not a related party of either Little Angel or Pharma. So independent third party, which has got 3%, but I think that 3% seems to be too small in percentage. Then there is individual public shareholders, that is note number 4. He says individual public shareholders have got 17,455 individual, and none of this individual has got more than 1% voting power. Can I call them as widely scattered?
Yes, sir.
So I can say that 52% of this company is supposed to be widely scattered across the individual shareholders of the company.
Yes, sir.
Okay, so
Sure.
we have now understood that if you look at the basic shareholding pattern of pharma company, we can say 45% is directly, indirectly held by Angel. 3% is held by a very small investor, and the rest is supposed to be widely dispersed in nature, held by thousands of individuals. And then he's also said in note number 1, none of the shareholders have entered into any shareholders agreement. So they have not entered into any agreement where they will act together. Now he says all the commercial decisions of pharma are taken by directors who are appointed by a simple majority vote of the shareholders in the AGM. So can I say, since all the decisions are taken by the board of directors and these board of directors are appointed by the shareholders of the company, can I say the voting power becomes the basis of control assessment?
Yes, sir.
Correct.
Yes, sir.
Now it says the voting pattern of the past AGMs can be seen. Now we can see some voting pattern in this case. So we can see that in the last 3 years, Angel attended the meetings and he voted in favor of all the resolutions. So this has been a practice in all 3 years. So Angel is been, attending the meetings every year and he's always voted in favor. As far as Little Angel is concerned, he is also attended and he's also voted always as per the directions of Angel for the last 3 years. So can I say, since little angel acted on behalf of angel, I think we definitely club the percentages,
Yes,
because
sir, definitely.
is under the control of angel and he directs him and tells him that boss, do what I tell you to do. So which means that this pattern is same. As far as wealth master is concerned, he is also attended and voted in favor of all the resolutions except the reappointment of retiring director. So can I say he has been, a little different as compared to the other investors. So he also voted, attended the meetings, regular in the meetings. But when it comes to the reappointment of retiring directors, he is voted against. Does this mean that he can act against, if let's say Angel and Little Angel appoint somebody as a director, can I say he might be going against it?
Yes, sir.
But do you think that 3%, what he has, do you think his going against the things, do you think it really bothers me?
Yes, sir.
No,
3%,
sir. No, sir, it won't.
yes, because he's got a 3% stake. So even if he, doesn't go in consensus with me, I'll say, okay, you just got a 3%. How does it really make a difference to me?
See,
No, it was
in the case, the wealth master, along with the individual, separate individual constitute more, then
Okay.
there will be a case of removal,
sir,
Okay,
rejection.
he,
so good. We can say that. So can I say as of now, let's say in the
No,
language,
no,
as of now, I'm not really concerned. I would say 3% what boss at the back will do against me.
no,
no,
Right?
sir.
sir. No, sir.
Sir,
No, sir.
he voted against one of the resolution, no? And
Hmm.
it was passed.
So I can say as of now, if I consider that he is a very small, minute shareholder, it doesn't bother me. But as somebody rightly said, that how the individual, those remaining 52% people are acting is going to be a little more important to me. But I think if those individuals are also acting with this 3% fellow, then it can be a dangerous situation, right?
Yes, sir. Yes, sir. That is what I am coming to say.
Yes, yes. Okay, now let's look at the individual patterns as well. So he says 7% of the individual shareholders attended the meeting. Oh, so out of 52%, merely 7% attend the meetings. Even the next year, 8% attended, then next year, 6% attended. And then he says all the shareholders voted in favor of all the resolution, and 50% of these individuals again reported against the appointment of retiring director. That has been the pattern in all 3 years as well. Now, let me just look at the larger percentage. Considering the wealth master and considering the individual, can I say the people who go against the resolution of reappointment of director, this is like 3 plus another 50% of 7. That makes it around 6.5. This is 3 plus 50% of 8. That makes it around 7. That is 3 plus another 50% of 6. That makes it another 6. Do you think that 6-7% people going against the resolution is a substantial percentage? First of all, out of those widely scattered shareholders, only around 6-7-8% of the people are coming and attending the meeting. Do you think, as
No.
Angel and Little Angel put together, do you think I am the single largest shareholder of this company?
Yes.
Yes,
Correct.
sir.
I would say I am the single largest shareholder, because in any case, the other individuals are there, but they are just on papers. They don't even come and attend meetings. And they don't even come and attend meetings, which means effectively the presence of those in the meeting are the people who will direct the relevant activities. Because if somebody is on the papers, a voter, but he doesn't even come to the meeting, which means that during the meetings, I am the single largest shareholder. And what I say, people adhere to that. A few people, of course, dispute. That doesn't mean that they can actually override me. I think we would have made up a mind so far. So do you think we are coming to the input that Angel, with of course Little Angel, is going to get a power or control of this company?
Yes, sir.
Yes,
Yes.
sir.
Yes,
Obviously, yes.
sir.
Okay,
Sir,
great. Now let's go
y-
further and let's have a look at more data. It says Pharma obtained a substantial long-term borrowings from a bank. The loan is repayable in 20 years from 1st April 17. As per the terms of the borrowing, following actions by Pharma will require the prior approval of the bank. Now, since the company Pharma, which is the subsidiary in this particular case, is taken a loan from the bank and there are certain actions which pharma requires, he needs a prior approval of the bankers. In which cases, payment of dividend to the shareholders, buyback of equity shares, issue of bonus shares, amalgamation of pharma with another entity, obtaining additional loans from any entity. What do you think the status of these kind of rights with the banker is? Do you think the banker is more interested in terms of protecting his own interest? Do you think this kind of action, this kind of prior approval on the part of the bank is going to take away the rights of the angel and little angel? Or do you think this seems to be more protective in nature?
Protective.
Yes, sir.
Protective in
Correct.
nature.
Absolutely, because in this particular case, we can say the farmer has got long-term borrowings which is taken from the bank. So the bank knows that if there is a bonus issue or if there is a buyback of equity shares or a payment of dividends, it could lead to a change in the debt equity ratio. It could lead to a change in the liquidity position of the company. So as a banker, I'm more concerned with any kind of actions taken with the company where it could put me to a disadvantageous position, changing the debt equity ratio, changing the liquidity profile. So the banker is acting more protective in nature. So I think this kind of rights for the bankers undoubtedly is not going to take away the rights of the other investor. Then he says recently the board of directors of pharma proposed a dividend of 5 rupees per share. However, when the CFO of pharma approached the bank for obtaining the approval, the bank rejected the proposal because they need a prior approval for declaration of dividends. So the bankers said they rejected the proposal, citing concerns over the short-term cash liquidity of pharma. Having learned about the developments, the directors of Angel, along with the directors of Angel Limited, approached the bank with a request to reconsider its decision. The directors of Angel and Little Agent urged the bank to approve a reduced dividend of at least 2 per share. The bank categorically refused to approve any payout. Now, since we are considering Angel and Little Angel as the majority stakeholder in the company, their request to the bankers is also rejected. Does that make a difference in the kind of power they've got, Little Angel and Angel have got?
No, sir.
No.
Yes,
That's
sir.
right. I think the refusal of the bank in terms of paying this dividend is only protecting its own right. It is nowhere interfering with the rights of the shareholder. The shareholders say that please pay dividends, and the banker says no. It puts me to a disadvantageous position. So I think the bank is merely trying to exercise his protective rights, where he's trying to safeguard himself. Nowhere he's interfering with the rights of the majority stakeholder, Angel and Little Angel. So under IGAP, Angel has been classified, pharma has been classified as an associate. As the CFO of Angel, you're required to comment on the correct classification of pharma. So can I conclude it becomes a subsidiary? Can I say under Indes, pharma is going to become a subsidiary of Angel?
Yes.
Undoubtedly, yes. Now, I'm not getting into the detailed answer, but of course, you need to write down the answer explaining all the inputs. So let's, I think, quickly take a run through on the three-step model. Though after reading the question, we've got the inputs, it's not. Let's, I think, still start the analysis with you. So we are starting the control assessment back in terms of step number 1, A, B, and C, and then in terms of step number 2 and 3. So then we'll decide whether a control is present or not. Let's put the first question to you. Can you tell me what are the existing rights of the investor Angel?
So existing rate, the angel has 21% of shares.
So can I say 21 plus 24, 45% stake in the company? Can I say
Yes, yes,
which
sir.
is less than majority?
Yes, sir.
Okay, let's now go to the step number 1B. So in this particular case, do you think it gives him a current ability?
Current, since
Do you
it
think
is
when the
a
need arises, he would be in a position to exert the influence? Yes, because you'll have
yes,
to
Future.
evaluate the existing pattern. You'll have to basically give the inputs about the pattern of shareholding, how the pattern of shareholding has impacted the decision. The current ability assessment is all about the pattern which is given. So we given this particular pattern in the question on the AGMs, give the analysis to the examiner on the AGM analysis, that how the voting pattern is happening, so whether he gets a current ability or not. And do you think it is on relevant activities? We presume that AGMs are the places where decisions are taken. Tell the
Yes, sir.
examiner that the companies are appointing the board of directors who are taking relevant decision. So I think since they are in a position to decide who is going to sit on the seat to take a decision, it is undoubtedly taking decisions on relevant activity. And then in terms of step number 2, do you think he's exposed to variable returns?
Yes, sir.
Because he's got equity dividends, so undoubtedly yes. He's got no other things, so whatever he's getting is dividends, and he's definitely exposed to variable returns. And then you can also link the concept of dividends out here and explain that the banker has got the decisions to approve dividend, but that means that he's getting exposed to variable return, but the banker's rights are protected. Make all that input, and once you've done all that, the linkage gets developed. So the overall conclusion after that would be yes, there is a control. So I leave the answer drafting to you. It's a May 2019 question. So I'll give you the basic structure of the control assessment as well. Right, friends, so far so good. My second objective met. So we're done with the scope, we're done with the control assessment. Now comes the most crucial part of the standard, and that is the consolidation. So in terms of consolidation, what I am planning to do is first just quickly give you the steps which we did in the regular classes in terms of what is the 7-step model to be applied. And then I am planning to give you a summary of the different kind of adjustments which are possible in a consolidated balance sheet, the different kinds of adjustments possible in an income statement, and then do some comprehensive questions with you. I think that sounds to be a good idea. I am first of all going to just give you an overview of the 7 steps which follows. So in those 7 steps, of course, I am also going to add a few inputs as well. So we're on the third agenda now, consolidation. So let's begin the journey with the third input, that is consolidated financial statements. So making the consolidated financial statements. So first we're going to focus on the balance sheet, and then we're going to focus on the income statement as well. So in terms of consolidated financial statements, we follow a 7-step model. If you've seen the regular sessions, you would have seen the 7-step model which is applied. So I'm just going to take a quick recap of the 7-step model, that what is done under each step. I'll not insert the adjustments at this stage. We'll talk of those adjustments. Or you want me to incorporate those adjustments as a part of the 7-step model itself?
Yes, sir, that would be great, because no, we can incorporate all the adjustment. Now itself, we can concentrate more on the solving the questions.
Okay, wonderful indeed. So let's do one thing. Let's first, I think, talk something, then document those 7-step models. I believe that there are basically a total of 5 adjustments one could, generally confront in a question. I'm saying they are not exhaustive 5, but they are 5 adjustments. So let's do one thing. First of all, just remind the 7 steps. I'm just going to document that. Don't worry. So I'm just going to first, remind the 7 steps and relate those 5 adjustments, and so that I can make a wonderful mind map in terms of what is to be done under each step. My first step is identifying the date of acquisition and the percentage, a simple exercise. My step number 2 is making the analysis of other equity and getting the net assets of the subsidiary on the date of consolidation. My step number 3 is focusing on the purchase consideration, which is, of course, based on Index 103, what we did in step 4 there.
There are 7 issues.
Yes, my step number 4 is in terms of calculating the NCI. My step number 5 is on the calculation of goodwill. My step number 6 is preparing the other equity in the consolidated balance sheet. What are you going to present as other equity in the CVS? And my step number 7 is focusing on making a consolidated balance sheet. So we need to consider 7 steps. I think let's first document this. We'll merge it out. We'll merge it out because I think we'll merge this as a part of the larger steps as well. So when you are making your revisions on the consolidated balance sheet, my focus comes on the 7 steps and my focus comes on the 5 adjustments. So I will rewrite these steps after this particular small chart. I'll rewrite the step that which adjustments is going to be incorporated in the step. So what are the kind of considerations you need to be careful on? So what I'm going to give you right now is going to be very important, because once we come to the practical illustrations, we need to be clear with these 7 steps. Now, the first step is that we need to get the date of acquisition and we need to get the person, which is of course not a big deal at all, because this will be clearly stated in the question. The second one is getting the analysis of other equity and also preparing, you can say, getting the net assets at date of acquisition. The step number 3 is getting the purchase consideration. The step number 4 is getting the NCI. The step number 5 is getting the goodwill or the bargain purchase gain. The step number 6 is organizing the other equity in the consolidated balance sheet. And finally, the step number 7 is making the consolidated balance sheet. So you need to proceed absolutely in a sequential manner. So when you're going to do the consolidation, just keep these 7 steps in mind and don't change the order in which it is applied. Now, let's consider what are the 5 adjustments which should come to your mind. The adjustment number 1 is in terms of intercompany owings. The adjustment number 1 is in terms of intercompany owing. So there is a common debtor-creditor relationship. So there is a common intercompany elimination to be done. The second is on the stock reserve. And when you're considering the concept of stock reserve, there could be a downstream and there can be an upstream transactions as well. You already know that in terms of downstream and upstream transactions, what do we mean? The third adjustments could be in terms of, you can say, goodwill impairment. So there will be adjustments pertaining to goodwill impairment. The next inputs in terms of the fourth adjustments could be as far as the omissions are concerned. Omissions in the sense that there might be some kind of entries which are omitted from the books of accounts. So like for example, there was a contingent consideration, or like for example, there was a deferred consideration and it stands omitted in terms of recording in the standalone financials of the parent. So there could be certain omissions as well. And finally, number 5. So intercompany owings done, stock reserve done, goodwill impairment done, omissions done. And of course, the most important you're going to see is the
Fair value adjustment. Yes, sir.
So I'm not saying that this is an exhaustive list of adjustments, but majority of the cases, these are the 5 kind of adjustments. And you know what? You should be very clear, which if you want, I'll make the chart later, but that would be post the associate discussion. Imagine that you should be very clear with the agenda that in a consolidated balance sheet, if you're given these 5 adjustments for a subsidiary and for an associate, what do we do? Imagine if you're going to make a consolidated income statement, the 5 adjustments in terms of subsidiary and associate. If you can make that consolidated chart in terms of all these 5 adjustments for the balance sheet and for the income statement for a subsidiary and an associate, life is jingalala. You want me to give you that chart? No, sir. Thank you. I've got no constructive obligation to do that now.
Sir, better we can give the chart, sir. The consolidated one. It will be good.
I just said that, I've got no constructive obligation. I said that say no, you don't want that chart. No, everybody was quite silent on that. I take your deemed silence to be a deemed acceptance on the fact that we don't need such kind of dangerous chart in life. Okay, let's now just connect the dots before we start, documenting those 7 steps in detail so we get a thorough review of that. So can you tell me if there is an intercompany owing? Can you please tell me which steps are you going to consider this?
Step number 7 directly.
That's right. So if you've got intercompany owings, that is going to impact your step number 7 directly. We can directly consider this in step 7, eliminate the common debtor creditor. What about the adjustment number 2, stock reserve down and up?
Sir, first, if it is a upstream, downstream, we need to decide it first. Based on if it is a upstream, hello, am I audible, sir?
It is frozen. Screen is frozen.
Okay.
There is some problem today. Speak to the BOS, Ashok ji. Samyanathan?
Yes, sir.
No, you speak to Ashok sir, the BOS. They'll
No, I
correct
don't.
it.
Yeah, I
Technical
don't know. Yeah. Ashok ji, the faculty voice is not receivable, and also the screen is freezed. Please support us. Oh, okay. Probably faculty will rejoin shortly, right?
Yeah, I'm just back. Actually, there was a sudden drop in electricity. Am I audible, I guess?
Yes, sir. You are audible and the screen also visible, sir.
Yeah. Suddenly drop in light. I think I was talking too dangerous indeed. The electricity authorities didn't like it. Just give me a second. Let me just put the board on.
Right.
This happens with me, when there's something technical going on, they don't like the speech and they take away the electricity at that moment.
Unavoidable.
Yes, that's true. Suddenly, I don't know, the electricity in Delhi has started going too much frequently.
Right, sir.
Just give me a second, I think, before the board ons. I hope the file is saved. Hopefully, yes. Yes. Right. So let's come back on the adjustments. Yes, so we were on the adjustments. So we were just trying to relate that which particular adjustments is going to be impacted in which particular step. So we discussed the intercompany owings is going to impact my step number 7 directly. Correct. Now we were discussing about the stock reserve downstream and upstream. So where do we take the impact in which steps?
Sir, if it is a downstream means from
Yes, parent to the subsidiary.
parent to the subsidiary, then we have to adjust the stock on the step number 7 and other equity related to that. We have to adjust in
Absolutely.
that.
So I can say if it is downstream in nature, the profit is made by the parent. So when you're going to take the step number 6, so we will take the impact in terms of step number 6 in other equity, and the stock will be adjusted in 7. And if it is upstream in nature, can I say then I need to take care of this in the analysis of equity?
Yes, sir. We need to take it as analysis of equity. We need to adjust the unrealized profit in the post acquisition profit.
Correct. So we've got step number 2 and 7. So we will
Yes, sir.
adjust the stock in step 7, and we're going to adjust the profits made by the subsidiary, rightly said, in the post acquisition period, because unless mentioned otherwise, we'll presume that the sale is made in the post acquisition period. Great. Then what about goodwill impairment?
Goodwill impairment, there is two situations, sir, actually.
Absolutely. Yes.
If it is a full value partial PSNA,
Very good.
If it is a PSNA, then with that parent portion will adjusted. If it is a full fair value, then entire thing will be adjusted against parent.
So can I put it like this, that if the goodwill is full, because NCI is taken at a fair value, because we saw in terms of business combination, if the NCI is taken at a fair value, the goodwill is full. And if the NCI is taken at PASNA, proportionate share in net assets, goodwill is partial. So if it is going to be full, can I say I will take the impact in terms of step number 4, 5, and 6. Impairment share of NCI gets adjusted in NCI, parent share gets adjusted in step 6, and the goodwill impairment in step 5. So this will impact the step number 4, 5, as well as 6.
Yes,
But if it is
sir.
going to be a partial goodwill, that means NCI will not bear the impact of goodwill write-off. So only in terms of step number 5 and 6. Correct. Okay, what about omissions? If there are any omissions, where do you take them, in which steps? Omissions. As I said, there could be a deferred consideration, contingent consideration omitted out. Recently, the question came in the exams, which I remember doing in the regular classes as well, where we had a case of omissions, and where do we take care of that, in which step?
During the net asset adjustment.
I'm afraid we're going to take the impact in the extract balance sheet. I said
Yes,
that before you start the question, we are going
yes,
to take the
sir.
impact in the extract balance sheet. So I'm going to fix all this in consolidated levels. And what about the fair value adjustments?
Sir, fair value adjustment, we will be considering the net asset level, sir. Net asset, we are
So
doing
in the
it.
analysis of equity, that's one, and
Yes,
in the
sir.
balance sheet in step 7. So can I say in terms of step number 2 and step number 7?
Yes,
Okay,
sir.
let's now do one thing. Since this is a basic structure, let's incorporate both these elements put together. Let's make some comprehensive input, that what are the focus points under each step? Because once you know that under this step, this is what I need to think, life is going to become more easy. So let's make a consolidated 7-step model on this basis now. So we are considering a 7-step model which is applicable to make a consolidated balance sheet as per Ind AS 110. So I'll try to focus on all the 7 adjustments which I've given you. If I miss out anything, please tell me what is to be incorporated. Let's begin. So first of all, in terms of step number 1, you need to focus only on 2 small little things, and that is percentage and date of acquisition. So
Right,
step
sir.
number 1 will have no complications at all, because you're just going to look at the date of acquisition and you're just going to get the percentage. So there's going to be no complications in step 1. Now, next, I think, is the crucial step in terms of step number 2, where I had given earlier as well. You need to see the type of question and then decide with what is to be done in step 2. So there will be 2 kinds of questions. One is where the consolidation is done on the acquisition date itself. The chances are less likely that you get a question where consolidation is done on the acquisition date. The other one is that the consolidation is done at a later date. So you're going to first of all identify the type of the question. And if the type of the question is that we're making a consolidated balance sheet on date of acquisition, or we are making a consolidated balance sheet post date of acquisition, the chances are great that you get a question post date of acquisition. Now, if you get a question which is a consolidated balance sheet on date of acquisition, then in this particular case, we just need to get the list of net assets directly. There is no need to do any analysis of equity in this particular case. In this particular case, you can directly consider the assets at a fair value on acquisition date minus the liabilities at fair value on acquisition date. No analysis required, because you're already given the balance sheet of the subsidiary on the same date. So you can directly get the list of net assets at fair value on date of acquisition, and that will finish the inputs. As I said, is less likely that you get this kind of a question. But if you get a question which is a balance sheet at a later date, you need to go for 2 steps. One is you need to go for analysis of other equity. One is you need to go for analysis of other equity of the subsidiary company, because this other equity is comprising of pre and post acquisition. And when you need the net assets on the acquisition date, you need the share capital and the pre acquisition equity. So then we're going to get the net assets at date of acquisition, which is going to be a sum total of the equity share capital plus the other equity, which is pre-acquisition computed above. Now comes the caution. Now comes the caution at this particular stage. When you're looking at the analysis of equity, I would say you've got a total of 3 focus points.
Yes,
When
sir.
you're looking at the analysis of equity in this case, I would say you need to keep 3 focus points in mind. Focus point 1. At the first stage, you're going to look at the balance sheet of the subsidiary company. Whatever is the other equity in the balance sheet of the subsidiary, do the pre and post split. The second focus is to look at any fair value adjustments in the additional information. And the third focus is to look at any stock reserve which is upstream in nature. Your mind should be very clear that, okay, these are the 3 inputs which I need to consider in this step. So when you're looking at analysis of other equity, we're going to consider 3 focus points very clear. One is we will look at the other equity of subsidiary company. So whatever is the breakup of other equity in the balance sheet of the subsidiary, take care of that. Split it between pre and post. The second is you need to look at the additional information. And in the additional information, you might be given any fair value adjustments. Thirdly, you need to again look at the additional information. And in terms of the additional information, you could see a stock reserve, which is supposed to be upstream in nature. Don't take downstream. You need to consider upstream. Now, let's also have a little look in terms of what you are going to do in terms of the fair value as well as in terms of stock reserves. So a little insights on that. Can I say in terms of the fair value adjustments, what you're going to do in the pre-acquisition column? Can I say the fair value gain or loss will be recorded? Am I right?
Yes, sir.
And can I say in the post-acquisition column, you are going to consider the additional depreciation, or you are going to consider the reversal of excess depreciation, correct?
Yes, sir.
That's right. So which means I should be clear that when you're going to carry out the fair value adjustments, my mind should tell me that in terms of fair value adjustments, you need to consider in the pre-acquisition fair value gain loss, and you also need to consider any additional depreciation. And shall I add some more inputs at this stage? Yes. Can this fair value gain or loss also lead to deferred tax implications as well?
Yes, sir.
Yes, of course. And I'm going to do a question with you, of course, when I'm going to take a comprehensive question with the deferred tax implications as well. So remember, when you take the fair value gain or loss, there could be an application of Ind AS 12 as well. And this application will lead to deferred tax consequences also. So this is one area which is started being touching now. So you need to be careful that a fair value gain or loss could lead to deferred tax consequences as well. And that deferred tax consequences will also lead to reversal of deferred tax consequences in the post-acquisition. Because when you go to consider the additional depreciation, this will also lead to the reversal of deferred tax as well. Wow. I think this must have been a little technical to hear that. Anyway, so we need to consider the fair value gains or loss with deferred tax implications and the additional excess depreciations in the post with the reversal of deferred tax consequences. Let's also talk about the stock reserve as well. Can I say if it is upstream stock reserve, this is going to be eliminated from pre or post?
Post, sir.
Yes, this will be eliminated from the post-acquisition column. Right, so I think this is the focus point. So you need to be clear that there is one input in step 2. Look at the type of the question first of all, because you need to decide, am I considering analysis of equity or not? So if your consolidation is on the balance sheet date, acquisition date itself, directly get the net assets done. But if it is later, then the analysis requiring 3 focus points and then getting the sum total of the share capital and the pre-acquisition equity. Next.
Sir, dividend, sir, dividend.
Which dividends?
Dividend, if it declared by the subsidiary company.
No. Dividend declared by subsidiary company would be a part of the notes. It cannot be in the part of the balance sheet. I got your point. You may be referring to the latest examination question where dividend declaration was given, right?
Yes, sir.
But that would be ignored in any case. Because you see, if they've declared a dividend as per Ind AS 10, it is something which cannot be incorporated into the balance sheet. So it doesn't hit my analysis. So I would say, if, let's say, for example, we are just given additional information, dividend declare, ignore it. Nothing to be done. Right.
Right, sir.
Now let's go to the step number 3. So once we're done with this, we come to the step number 3. And in terms of step number 3, you need to calculate the purchase consideration. Now my inputs now at this stage is, before you consider the 7-step model, I would advise you should make an extract balance sheet. So even before the 7-step model, the first thing is that if there is a need, make an extract balance sheet if there are any kind of omissions. I'm saying if there are any kind of omission, so this is going to precede the 7-step model. So even before the 7-step model, I am going to make the extract balance sheet. When you read a question, you see that there is any kind of omissions given, extract balance sheet should be made. Any DC missed out, any CC missed out. So all those things can be there. So take care of that at that stage. As far as a purchase consideration is concerned, I think you need to keep the list of those 7 issues in mind. The 7 issues which I gave you in terms of Ind AS 103.
Yes, sir.
Because most of the times, the purchase consideration is nothing, but it is the investment which appears in the balance sheet of the parent. But you need to be careful that sometimes there might be omissions. Though when you would have made the extract balance sheet, the omissions of that considerations would have been taken, but you need to be careful on the 7 issues which might be there. Next comes the step number 4. In terms of step number 4, we are going to calculate the NCI. Now, I would say there are again 3 focus points on the calculation of the NCI. One is you're going to consider NCI on date of acquisition based on fair value of PASNA, which will lead to the inputs goodwill is full or partial. Second, you need to consider the share in post-acquisition profits available from the analysis of equity. And third, you need to consider a goodwill impairment if the NCI is at a fair value, the goodwill is full. 3 focus points. So let's put this across. So when you go to consider the NCI, we are going to consider a total of 3 focus points here as well. So in terms of the 3 focus points, the first one is we need the NCI on date of acquisition. Can I say based on Ind AS 103, either
Yes, sir.
taken at a fair value or it is taken at PASNA, which the examiner would tell me. That's going to be the focus point. So I'll not consider the dividends out this stage. This stage could be disturbing. So I think that we can take care of the question itself. So one thing which you need to consider, the moment you identify this, you need to know that if the NCI is at a fair value, this is going to lead to a full goodwill. And the NCI is at PASNA, this is going to lead to a partial goodwill with consequences on impairment testing to be taken care of. The second focus point which we need to consider in this particular case is that we need to add the share in post-acquisition profits. We need to add the share in post-acquisition profits in this case. And you're going to get this information from the step number 2A, where you've done the analysis of other equity. So this inputs will be available from the step number 2A, analysis of equity. And what is the third focus point which I said?
Is reduce the impairment of goodwill if only the NCA is at full fair value. Fair value.
Wonderful. So the third impact to be seen is the goodwill impairment. We need to consider the goodwill impairment, that is NCI share. If goodwill is full, that means NCI at a fair value mentioned above. So this is the focus points when you're calculating the NCI, that you need to keep the 3 focus points. And I'm trying to give you the position 333. So remember, analysis of equity, 3 focus points, NCI again 3 focus points. Then comes the step number 5. Then comes the step number 5. And step number 5, we need to calculate the goodwill or the bargain purchase gain. And in which particular case, I think there is only one focus point in this case, and that is goodwill impairment. Rather, I would say, yes, we can say that there are 2 focus points. I'll tell you why. So when you go to calculate the goodwill on the date of acquisition, you're going to take the purchase consideration, and this will be available from step number 3. And to this, you're going to add the NCI. Are you going to take the NCI from step number 4 or the NCI on the date of acquisition?
Sir, we will consider NCA on date of acquisition.
Correct. So we are going to take this information, of course, from the step number 4, but we don't need the total NCI. We don't need the total NCI. We need the NCI on date of acquisition. And if there is going to be difference, we need to be careful, because this NCI on the date of acquisition would be different as compared to the NCI in step number 4. I hope you're making sense on that. Because if you remember, we'll be doing a question also in the next class on that. But if there is any kind of dividends, then the NCI, which is computed on date of acquisition for NCI calculations, and the NCI, which we're going to consider here, is going to be different. Let's talk of that later. So you add this, and then you compare this with the net assets at date of acquisition, which is available in terms of step number 2B. So I think one of the focus points which I gave you is this. So this is one focus point, that you need to consider the net assets, the NCI on the date of acquisition. What do you think is the next focus point in terms of goodwill?
Sir, we need to reduce the impairment of goodwill, sir. The entire loss we need to reduce.
Absolutely good. That's correct. So the next input is what we need to do in this particular case, reduce the impairment of goodwill. And we need to reduce the entire goodwill impairment and not the share. So we will reduce the entire impairment figure. We don't need to consider the share of the parent. So we need to reduce the entire impairment figure because we need the revised goodwill out here. So I would say this becomes the second focus point as well. So these are the 2 focus points in terms of goodwill. So this becomes my focus point number 2. Right, so that is on the step number 5, that when you calculate the goodwill, you need to consider NCI on acquisition date, and we need to consider goodwill impairment irrespective fair value pasna, whatever. The next is the step number 6. And in terms of the step number 6, we need the consolidated balance sheet, other equity. Again, we've got 3 focus points here as well. When you're considering the consolidated balance sheet, other equity, the first is we will take the parent company's equity as a base. That's not a focus point, that's a base. The first focus point is taking the share in post-acquisition profits. The second is considering the stock reserve, which is downstream in nature. The third is considering the goodwill impairment, depending it is supposed to be full or partial in nature. So 3 main focus points. So when we're going to consider the things, we will take holding companies' own other equity as a base. So we're going to consider the holding company's own equity as a base, and then we will consider 3 focus points. So in this case, we're going to consider 3 focus points, number 1, number 2, and number 3. The first is we need to consider the share in post-acquisition profits. We need to consider the share in post-acquisition profits. And where are you going to get the share in post-acquisition profit? Step number 2A.
2A.
And then this is something which is going to be added. Then there is going to be a subtraction in terms of goodwill impairment. And in this particular case, when you look at the goodwill impairment, I would say there are two cases. The goodwill is full or the goodwill is partial. So what do we reduce in this case?
Yes, sir. If it is a goodwill is partial, then we will reduce the entire share, entire loss.
Very good.
If it is a fair value, then only the parent share alone we will reduce it.
Very good. So if it is full, we will reduce holding company share. But if it is supposed to be partial, we need to reduce the entire goodwill impairment. So everything is borne by the parent in that case. So we'll reduce the entire goodwill impairment figure. And then we also need to take care of reduction in terms of stock reserve, which is downstream or upstream in nature.
Downstream, sir. Upstream
That's
we will consider steps 2A.
Wonderful indeed. So we'll take the stock reserve that is downstream. So these will be the three focus points in terms of the step number 6. So now you can see step number 2A, 3 focus points. NCI, 3 focus points. Step number 6, 3 focus points. Goodwill, 2 focus points. So you got 3, just one place at 2 focus points. 3 focus points at 3 different steps. And finally comes the step number 7 as well. So we've got finally the step number 7. And step number 7 is making a consolidated balance sheet. So here you need to apply the 5 rules which I gave you, which indirectly becomes my 5 focus points. Number 1, the equity share capital of subsidiary does not appear in the console. Number 2, the reserve and surplus, the other equity of the subsidiary pre-acquisition does not appear in the console. The post does appear through the various steps. Number 3, the investments parent is got in the subsidiary doesn't appear in the console. Number 4, goodwill NCI are inserted as separate line items in the console. And number 5, aggregation of assets and liabilities are done. And that is always full because when you establish a control, the consolidation is always full in nature. So we can lay down the 5 rules which you need to apply. So in this particular case, apply the 5 rules apart from the intercompany owings and the fair value adjustments. That also I'll just make a mention. So when we're going to make the consolidated balance sheet in terms of the 5 rules, the first is we need to eliminate. We need to eliminate the investment which the holding is got in the subsidiary. It never appears in the console. Second is we need to eliminate the equity share capital of the subsidiary company. Thirdly, we need to eliminate, you can say, the other equity of subsidiary company, but that's only pre-acquisition, not post. And number 4, we can say we need to insert number 1, goodwill, and number 2, NCI as separate line items in the balance sheet. Where does NCI appear?
NCI appear in the equity section. First equity, other equity. Below that, NCI will appear.
Very good. So this is going to be a part of other equity, but at the last item. And then finally, we said we go to aggregate assets and liability 100%. So we will aggregate the assets and liability always 100% because consolidation is always full. We follow the concept of full consolidation. And apart from this, when you're making the consolidated balance sheet, go back to the adjustments. Intercompany owings to be taken care. That's 1. So intercompany owings to be taken care, that is 1 input. Then there is a stock reserve which needs to be reduced from the stock. So we need to basically reduce this from the stock. That is another input.
Fair value.
The fair value adjustments in terms of the asset, including depreciation impact. Omissions already taken in the extracts and goodwill impairments already taken care. So apart from these 5 rules, you can say this is another 3 areas to be taken in terms of adjustments. And that gives me a complete overview of all the 7 steps, the focus points which need to be done. Now, what you need to do, friends, is revise these 7 steps carefully, because we'll start doing questions on this area in the next class with you. We will devote only to the practice in the next class. The next 2 classes, we're going to do extensive practice on various types of questions on consolidated balance sheet as well as on the consolidated income statement. Though I will also give you a revision when we come to the income statement of what kind of inputs do we need to keep in mind. And then I'll give you the chart also, but that would be post associate standard, where we look at the 5 adjustments in the balance sheet, in the P&L, with the subsidiary and the associate. But that would be later. Right, friends. So I think that takes care of the insights, so quick revisions on these particular concepts. So please, as I said, revise all this part, because next class we're going to do questions with you on this area. Any questions on your side, friends? Okay, I think our ma'am has also joined in. Good morning, ma'am.
Good morning, sir. Good morning, students. I hope you all are filling that feedback form and are in that WhatsApp group. One important announcement I would like to make, that is why I'm there, is that on Monday and Wednesday, instead of consolidated financial statement schedule class, that has been postponed, shifted later for your 13th and 14th class, and Monday and Wednesday, that is on, so it is 7th and 9th, no?
Yes, ma'am. Yes, ma'am.
7th and 9th we'll be taking quiz. First, on Monday we'll be having quiz on financial instruments, and on Wednesday we'll be having quiz on your business combination. So we request everybody to be there. So just it will be helping you in understanding how much you have understood from the previous classes and where you need to further work upon. Okay, it will be interesting and interactive. It will be basically rank based, everything will be so time based, poll based, it will be there. So it will be a different thing for you. So we request everybody should be there. Okay.
All right,
Thank you,
ma'am.
ma'am.
Thank you, ma'am.
Okay, sir. Over to you, sir.
Thank you, ma'am. Right, friends. Any questions on your end for the day?
Sir, it's very clear, sir. Thank you so much for elaborating everything in detail. Thank you so much.
Thank you very much indeed.
Thank you, sir.
Thank you very much, friends. So I think it's time to bid you goodbye. So see you on the next class with some good practice. Please remember to revise all this and take good advantage on 7th and 9th for the quiz which is going to happen, because I think those quizzes also gives you a lot of insight and helps you revise small little intricate points as well. So thank you very much. See you on Sunday, friends. Bye-bye and take care.
Thank you, sir. Bye. Have a wonderful day.
Thank you. Thank you very much. Anji, thank you.